Capital. We don't ascribe to the view you shouldn't meet with management to avoid being sold. A personal connection gives us a better understanding of what's going on, allows us to judge management more directly, and even can give us some influence, all of which we consider necessary to invest with conviction. Randall Abramson, Trapeze Asset Management. My style is to meet with management each quarter and basically ask the same questions. There can be good reasons for different answers, but I want to see a consistency of answers. Also critical is a passion for the business, a will to win, which you can only judge by sitting across the desk. Thomas Brown, Second Curve Capital. Red flags. Few things are as frustrating for an investor as the sense of being misled by management and subsequently caught off guard by what appears to be value-destroying behavior. As a result, top investors can be a skeptical lot when dealing with management and are particularly sensitive to red flags that may signal management's propensity for non-shareholder-friendly behavior. I started my career doing criminal defense work and learned a lot from having my clients lie to me and having to see through that. That's been invaluable in dealing with corporate America. Edward Studzinski, Harris Associates. There's just a huge amount of skill in exposition. Part of being a wise person is resisting the other person's expository, to know nonsense when you see it. If you're like me, you can conceal your contempt for the person even as they speak. Charlie Munger, 2006 Wesco Annual Meeting. When I started in research, I had one of the worst character traits an investor can have. I was a believer. I was too often seduced by charismatic CEOs and by concept stocks, where the product or service made a lot of sense, but there turned out to be cost, competitive, or other reasons it would never succeed. I learned the hard way to be a skeptic about management's, and my own, ability to forecast with precision well into the future. Francois Parento, Defiance Capital. Meetings with management tend to be promotional, and I'm a sucker for a charismatic CEO. Early in my career, I met with Dave Thomas, the founder and CEO of Wendy's. He was an incredibly nice guy, and he told me over lunch all about this pita sandwich concept they were rolling out. I came back to my portfolio manager and said, "You have to buy Wendy's. This pita thing is going to be big." This was in 1996 or 1997, and the launch was a flop. That's one of the last times I went to meet management. We do a lot of in-depth list questions for management as part of our research, focused on getting direct answers that help us understand the mechanics and personality of the business. I also find earnings call transcripts quite useful, particularly the Q&A sections. Reading a lot of them, across an industry and over time, can give you a decent sense of what's really going on. Eric Cinnamond, Intrepid Capital. One acid test I use is simply whether in talking about the business and the external environment in which they operate, are they describing reality as I perceive it? There's surprisingly often a disconnect there, where they either aren't owning up to potential missteps or recognizing external challenges. When that happens, you just cannot give them your capital to manage. Matthew Berler, Osterweiss Capital Management. Several years ago, I made an investment in Cannondale, the bike company. I'm a cyclist, so I knew and liked the product. I went to visit the company around the time they had decided they needed to diversify by manufacturing all-terrain vehicles, ATVs. The CEO was then a pilot, as I am, so I find myself with him flying the company's plane to visit a new ATV plant. I test-ride the ATVs and fall in love with the product. I was so impressed by everything that I wasn't as careful as I should have been in analyzing whether getting into the ATV business was even a good idea. It wasn't. Not long thereafter, the company ended up being taken private. The CEO got kicked out and the equity ended up being worthless. I tell that story because it's always important to remember the risk that your judgment can be compromised when you get too close to management. Francois Parento, Defiance Capital. I've been fooled many times by being too impressed by executives who are articulate and have done well in the past. I've learned to be humble about my own opinions and rely more on the opinions of people who aren't biased and have known the management personally or professionally for a long time. Ed Wachenheim, Greenhaven Associates. We look for behavior patterns in management that are consistent with an efficient and prudent guardianship of our assets. If we visit a fan manufacturer in Texas and the CEO meets us at the airport in his Lexus, spends 5 hours with us, and then takes us out to an expensive restaurant and buys $300 bottles of wine, that is suggestive of somebody who isn't as prudent as we would like. We try to meet management of all the companies we own, but I must say that over the years I've become more skeptical and less believing of people. I don't really want to know or like these people any more than I need to. We generally think it's more interesting to talk to industry salespeople, ex-salespeople, and customers of the company's products to truly understand what's going on. Carlo Cannell, Cannell Capital. One red flag is when management sits down with us and right off asks, "What do you think is wrong with our share price?" Any implicit or explicit focus on the share price rather than the business is a bad sign. This may sound funny coming from an investor, but we also don't like to see managements spending an inordinate amount of time at investor conferences. The value add to the business is likely to be much higher by spending the time with customers and their own employees. We're also not fans of the lavish executive office suite. It's not their money. We basically want the capital we as shareholders have entrusted to management to be treated with as much respect as we treat the capital that has been entrusted to us. Edward Studzinski, Harris Associates. We care a lot more about what management is doing, which is very well documented, than what they are saying. I can learn everything I need to know about management by looking at the numbers. I can see how conservative they are. I can compare 3 years of shareholder letters and see if they are discussing problems openly and addressing them. If a company isn't discussing any problems, I don't believe what they're saying. I can see if disclosure is complete and easy to understand. If I have to call to get something important explained, there's something wrong. I have yet to hear a management team warn of an existing problem that, if not resolved, would result in a dramatic drop in the share price. Given that that's exactly what I most care about, I better do a lot more than listen to management to form my opinions. Robert Olstein, Olstein Capital Management. Management is clearly a potential resource, but you always have to consider the source. It can be like asking a bartender if you need a drink or a barber if you need a haircut. Carlo Canal, Canal Capital. It comes down to doing business with people you trust. We pay careful attention to all management communication. Does the CEO write the shareholder letter himself or herself? Do they tell you when they've been right and when they've been wrong? Do they talk about what's difficult about the business? Do they articulate how they allocate free cash flow and do so with an owner mentality? Are the key benchmarks consistent? We worry about companies that 1 year focus you on adjusted net operating EPS, then the next year on EBITDA margin, and the year after that on something else. Adam Weiss, Scout Capital. We put a lot of emphasis on how management communicates. All shareholders are entitled to candid, timely communication from management, and when it's lacking, it's pretty obvious. You can be 2/3 of the way through a shareholder letter, and it may be so full of consultant speak that you have no idea what the company is or what industry it's in. That leads us to wonder whether management is really thinking about shareholders as owners of the business, who deserve clear and complete information so they can make important decisions as owners. We're also leery of mission statements that get sidetracked talking about various stakeholders and obligations a company has to the community. Those things are important, but only in the context of maximizing the long-term business value. If you don't treat employees fairly, you're not going to have the labor force you need to maximize business value. If you don't treat customers fairly, you can't maximize business value. We get concerned when those types of things are laid out as independent objectives, rather than just part of what management should do to build long-term value. How management communicates about mistakes is very important. No one is mistake-free. As investment managers, about 40% of the stocks we buy end up underperforming the market. And I'd be concerned about any company where shareholder communication doesn't include a candid assessment of mistakes. Bill Nygren, Harris Associates. I'm particularly averse to the gobbledygook that passes as communication for some managers. Are they thinking clearly and logically about problems, or just repeating buzzwords? John Osterweiss, Osterweiss Capital Management. We hope to add some value in assessing the coherence of management strategy, how they're making capital allocation decisions, where they're putting specific emphasis, and how they're measuring success. An inability or unwillingness to articulate all that is a red flag, as is a focus on the ends rather than the means. You want to be confident that decisions are being made out of the good analysis of a set of probabilistic outcomes, not hope or ambition. Brad Singer, Value Act Capital. Some of my biggest drubbings have come from not responding quickly to inconsistencies in what management is saying over time or in different forums. Changing stories are a huge red flag. Robert Leitzow, Lakeway Capital. I've made the point in the past with Coca-Cola about the danger of having management that knows the business side cold but doesn't understand the product and its relationship to consumers. The best managers bring both skill sets to the table. Morris Mark, Mark Asset Management. The hardest thing is to find management that actually objectively behaves in shareholders' interest as opposed to their own long-term interest. It's not what they say, it's what they actually do. A lot of people tell a good story on shareholder value, but their behavior belies that. Take SPX Corp., the industrial company that came out with this elaborate description of how they were focused on EVA, economic value added, until they didn't hit their targets, and then the board changed the criteria and gave management their bonuses anyway, saying, "It wasn't their fault, the economy was bad. Why should they get penalized for that?" So, you're looking for managements and boards that actually act in shareholders' interest, and there aren't many of them. Bill Miller, Legg Mason Funds. Whether we're investing in New York, Zurich, or Kuala Lumpur, we do everything we can to ensure that the people to whom we've entrusted our capital wake up in the morning focused on how to make money for all shareholders, and that they're good at it. A lot of that is just seeing what they've accomplished and how they've behaved in the past, but their incentives are also critical. You want to see management own real equity in the business, without the heads I win, tails I win bigger types of compensation packages that have been handed out over the years. David Winters, Wintergreen Fund. There is no way to make a good deal with a bad person. It's the character of the people you go into business with that will fundamentally determine your investment returns and your ability to sleep well and eat well in the meantime. If you're not comfortable with the people involved because of their prior conduct and how they've treated shareholders, you're probably not going to be comfortable with your investment results. I take it to heart and use it as a screen for potential investments. Thomas Russo, Gardner, Russo & Gardner. When a company has integrity issues, there's no firm ground. If somebody is willing to do the medium-sized crime you know about, there's no particular reason they wouldn't have done the bigger crime you haven't found out about yet. Wally Weitz, Weitz Funds. There's really no substitute for direct communication. Looking people in the eye, gauging the tone of their voice, trying to read the level of energy and enthusiasm they have. We spoke not long ago with management of one company and asked if they were still on target with their profitability goals, and the answer started, "Well, yeah," which clearly didn't sound good. Amelia Weir, Paradigm Capital. Catalysts. Almost as important as identifying the extent to which a stock is undervalued is assessing what can make that misjudgment by the market go away. After all, the proverbial 50-cent dollar that value investors seek will produce a very different investment result if the gap between price and value closes within 1 year or if it takes 10 years. For that reason, most, but not all, successful investors put emphasis in their analysis on the potential catalysts that can trigger an enhanced market appreciation for a company's business and its shares. Our strategy goes under the general category of event-driven. We're value investors looking for mispriced securities at any level of the capital structure with specific catalysts that should help trigger a narrowing of the gap between the market price and our estimate of intrinsic value. The basic idea, which has probably been best articulated by Seth Klarman, is that if your investment is more predicated on an event occurring, that transfers risk away from the vagaries of the market to the specifics of the particular investment. That doesn't mean you'll always make a lot of money if you're right about the event, but it helps clarify the analysis and allows you to arrive at firm conclusions. We do have traditional investments based more on a broad-based analysis of the business, but even in those, we like to have specific catalysts to track. In the case of Walmart, for example, we were focused mostly on the company slowing down expansion, reducing spending on new stores and acquisitions, and giving that money back to shareholders. It can be a bit fuzzy to determine exactly when an event like that has occurred, but our judgment that it has occurred is usually what starts us down the road to selling. Timothy Mullen, VNBT Trust. Since the crisis, there are fewer fundamental long-term investors in the market. It's bots or traders playing a game on the next quarter's earnings or people making thematic macro bets. As a result, the market is assigning less value to the durability and consistent growth of cash flow, which is why quality stocks have increasingly become cheap. For most of your readers, investing in a high-quality company that is 30% undervalued and can compound value at 15% over a 3-year time horizon is a great investment. But for your typical trader, it's more like kissing your sister. That has also caused a change in the market dynamic. The playbook for fundamental investors has been to value businesses based on expectations for growth and profitability and buy them when that value is much higher than the current stock price. There were guardrails in the form of lots of other investors doing the same thing that kept valuations in check while you were patiently waiting to be proven right. Without enough of those types of investors, however, the guardrails have been blown out. That means the quality value stock working through some negative fundamental development can trade way through what you could imagine on the downside, and the low-quality stock, still doing okay, can blast way beyond your assumptions of economic fair value on the upside. You could say, gee, doesn't that just create greater opportunity? Yes, but it can extend the time it takes to get paid and creates much more risk to shorter-term performance. That's been a challenge for us. We've had to ask ourselves if our job as a hedge fund manager is to figure out the value of businesses or to figure out where they trade in a year. I know we're good at the former. The latter is difficult and requires a different skill set in judging things like near-term earnings versus expectations and changes in investor perceptions. On the long side, we're paying more attention than before to the presence of things that can create a change in investor perception. We're then overweighting the stocks with the quality value we've always emphasized, but where we also have the highest confidence we'll see a change in investor perception over the next 18 months. Those highest conviction ideas will be 4 to 8% positions, while the good businesses with a cheap stock but we have no idea when it works, that's probably a 2% position. Too high a weighting of those latter types of positions can make you really underperform for longer than we or our investors are comfortable. Ricky Sandler, Eminence Capital. The catalysts we look for can be company-specific or more macro. It could be any number of things: new management, a reorganization, buying back stock, a new product launch, the resolution of litigation. It could be a call on a specific sector turning up. We're just trying to push back against the natural propensity of value investors to be early. There's just no way around the fact that if you're way too early, you're wrong. William Nasgovitz, Heartland Advisors. We're generally of the school that a bargain that stays a bargain is not a bargain. We may buy something just because it's cheap, but it's very unlikely to be a core position without a data point or two, like earnings exceeding expectations or an asset sale that we think should move the stock. Curtis McGwen, Ivory Capital. We're selecting for companies that are entering episodes of their public lives in which they're going to be transformed. We do both the fundamental valuation work as well as an analysis of the probabilities of successful value-unlocking outcomes. We tend not to focus on short-term opportunities in which we may have no real edge, or on very long-term buy-and-hold-forever investment themes. There's a medium term where the risk to reward can be quite high if we stick to our value-plus catalyst discipline. Gary Klar, Jana Partners. Given our emphasis on improving valuations, catalysts tend to be important to us. The catalysts can be things like a successful new product introduction, the onset of a new product cycle, a change in senior management, the divestiture of an underperforming division, or simply better financial performance. There must be identifiable events that would cause rational expectations for the business to improve, resulting in a higher valuation. Brian Barish, Cambiar Investors. We think it's difficult to have a reliable view of events beyond 12 to 18 months, so we focus on specific investment catalysts that can move stocks toward their warranted target prices over the next 12 to 18 months. We've identified 5 primary catalysts: management, restructuring, problem fixing, new products, and pricing flexibility that we believe can consistently take advantage of pockets of inefficiency in the market. Larger cap stocks are usually priced relatively efficiently, but we found this focus on catalysts helps us identify when they aren't. Jeffrey Sensor, Institutional Capital, LLC. With large caps, regression to the mean seems to work often enough after things have gone bad, but in small caps we believe identifiable catalysts like management changes, restructurings, or maybe industry consolidation increases the odds of winning. Preston Athey, T. Rowe Price. For lower quality businesses, we put more emphasis on whether there is a catalyst or not. If something is cheap but the business dynamics aren't great, time can be your enemy unless you see a clear catalyst for value to be recognized. Jeffrey Tannenbaum, Fir Tree Partners. We sometimes make a distinction here between blue-chip companies and less than blue-chip companies. For example, our purchases of Google and Johnson & Johnson were probably a bit catalyst light and had more to do with our view that negative perceptions of each would turn out to be not as negative or long-lasting as the market seemed to fear. With somewhat lesser quality names, we typically want more definition around the catalyst or inflection point. It's one thing to sit a while with J&J in your portfolio than it is some lesser quality company. John Osterweiss, Osterweiss Capital Management. If there's a disparity between price and value, we like to know when that might close up so we can figure out our expected rate of return. Having said that, some situations are just out of favor and cheap, and there is no catalyst other than a change in people's perceptions, which usually happens within 2 or 3 years. When we find a cheap situation with no catalyst, we'll likely want it to be available at a lower price than one that does have a catalyst. Joel Greenblatt, Gotham Capital. In general, we're not obsessed with seeing near-term catalysts. If those are clear, the stock is probably 30% higher. But it obviously matters when things return to normal, so we judge everything based on an internal rate of return. If we can't reasonably expect a return to normal in both earnings and the multiple paid on those earnings over a period that produces an IRR from today's price of at least 20%, we typically consider the risk of it being a value trap too high. Lee Atzel, Pennant Capital. We rarely count on the catalysts most people talk about. 1, because you set yourself up for disappointment if they don't materialize, and 2, you can get too caught up in a stock's story and be less driven by the numbers. Jeff Kautz, Perkins Investment Management. There's the perception that having specific catalysts for all your positions mitigates risk, when in fact we believe the opposite is true. If there's an obvious catalyst, there's an excellent chance that it's at least partially priced into the stock, which increases your risk in the event it never shows up. As long as the potential return in an investment is significant enough and the potential downside is limited, we're okay with dead money. Tucker Golden, Solus Capital. We really don't pay that much attention to why something is undervalued. If we buy companies in which shareholders' capital compounds at a 20% rate of return over a reasonable time period, and we pay a below-average multiple for it, our investors will do extremely well. Chuck Akre, Akre Capital Management. We focus first on good businesses with high returns on capital, barriers to entry, and significant free cash flow generation over a cycle. If you're right about the business, time should be your friend, so catalysts are not important. Charles DeVoe, International Value Advisors. In our experience, it can take a lot longer for value to be realized than we expect, but that it's taking longer doesn't mean we've made a mistake. If the market hasn't recognized the value we see and the company is continuing to increase its intrinsic value, that's when we'd be buying more. Rick Dillon, Diamond Hill Investments. Getting it done. Sometimes, lost in the discussion of the vast quantities of information an investor can look at and, in researching an investment, is an appreciation for the effort, diligence, and creativity required to unearth that information. Knowing what you need to know to make a decision is obviously important, but equally important is that the information you acquire is complete and accurate. This doesn't just happen, and many investors look to distinguish themselves by the breadth and depth of their information gathering process. How credibly they make that case and deliver on that premise is a valuable indicator of how successful they are likely to be. We're big believers in that Peter Lynch quote that the person who turns over the most rocks wins the game. We always say that people who know what they're doing can get 80% of the story in no time just by looking through the financials, but it's that last 20% that requires tremendous effort and that is going to set you apart or not. That's the detective work, the site visits, the channel checks, the background checks, the legal research, all the things that may or may not give you unique insight, but which you have to do well to get any kind of edge. Scott Hood, First Wilshire Securities. We take all the computer screening we do very seriously, but that's the easy part. The harder part is going through the public documents, reading call earnings transcripts, and speaking with management and people outside of the company who can shed light on the business, all in an effort to make conclusions about the sustainability of the business and its cash flow. How leveraged is the income statement to ups and downs? Does the company have much control over its pricing? Is there margin upside versus peers, or are the margins threatened by new competition? Is there technology risk? How does EBITDA cover interest expense in a downturn? All of this is the hard work of securities research, for which there's no substitute for rolling up your sleeves and going at it. Company co-founder Howard Brown was fond of saying, "No one ever learned anything by talking," and we still try to take that to heart in how we approach our research. John Spears, Tweedy Brown Company. I learned early that you should never cut corners in research, even when you think you can. It's like remembering to bend your knees in tennis. Timothy Mullen, VNB Trust. In the field research we do, we're not trying to assess whether sales are going to be up 6% rather than 4% next quarter, but focus more on things like the quality of the company's products or services relative to the competition, how they conduct themselves, the pricing trends in the industry, and whether there are material shifts going on in market share. Everyone probably says this, but we just don't think you can underestimate the importance of speaking to not just a few, but a lot of customers, suppliers, competitors, and people in all levels of the company. We're constantly trying to triangulate and confirm what we hear or see elsewhere. If returns on invested capital tells us it's a great business, we also want to hear from customers about why they value the company as a supplier and expect to continue to do so. If the company expects to increase market share, we want to hear directly from competitors why they don't think that will happen. Taking shortcuts in due diligence, for whatever seemingly decent reason, is just a recipe for disaster in our view. Robert Williamson, Williamson Macquarie Investment Partners. Often there are specific issues central to our thesis that we need to better understand. To own Oracle, for example, we needed to believe that it was integrating its many acquisitions in a more customer-friendly way than just ramming its own products down acquired customers' throats, which was a concern of the streets. We also had to believe that its maintenance revenue stream was sustainable, which, if so, made it possibly the single most defensive business I've ever looked at. These are the types of things you can only really address in the field, and we wouldn't have been comfortable owning the stock in volume without doing so. Ricky Sandler, Eminence Capital. I want to talk directly to people installing solar panels, or buying and selling a certain kind of shoe, or taking classes at a for-profit college at night. It's one thing to read a sell-side report or go to a conference, but it's another to understand firsthand how decisions are really being made about the products and services sold by companies in which you want to invest. I want to do that type of thing myself, rather than read notes from someone 2 years out of business school. Sean Kravitz, Esplanade Capital. I'm still amazed by the things you'll see or hear on a company visit. We visited one company in Florida that made simulators for pilot training and amusement rides, and heard all about the long lead time between the start of contract negotiations and product delivery, including 9 months or so for manufacturing. Later on in the day, we toured the manufacturing facility, and of the 12 assembly bays, only 2 had anything going on. That wasn't a big endorsement of the company's prospects. Scott Hood, First Wilshire Securities. We want to learn from personal experience. Every spring, I give everyone in my firm $500 to open 2 accounts at local banks and then report back on the experience. I'm a big believer that a company's success is about execution and the hundreds of little things that one company does better than another. We want to understand that for the companies we invest in. Is the party line we're hearing actually what's taking place in the branches? In the bad companies, there's an enormous difference. Thomas Brown, Second Curve Capital. This is an old story, but a great example of when we did learn something was when Bill Smithberg of Quaker Oats bought Stokely Van Camp, which was owned by Gatorade. We couldn't understand the price he was paying, which seemed completely out of bounds. When we finally got an audience with him, he explained that the economics worked for Quaker to pay 1 times revenues for any strong regional brand that it could flow through its national distribution system. It was obvious and simple to him, but we hadn't figured that out. That changed the whole way we looked at branded food companies, and led us to invest in Nabisco, which got bought out, General Foods, which also got bought out, and others. The lesson there is how important it is to get out there and talk to people. If you spend all your time with your models and spreadsheets, you're likely to miss something important. You need to understand how the economics work for the people who are making the actual decisions, and when you come across something you didn't know that has broad application, it can be very useful. Clyde McGregor, Harris Associates. Peter Lynch's greatest influence, which still pervades Fidelity, is that you pick up the phone and call companies. At the end of the day, if you haven't spoken to a few companies in existing positions or on new ideas, you go home a failure. That's a good discipline. You should spend your day talking to operators, not to Wall Street. Jeffrey Ubben, Value Act Capital. We spend time speaking with competitors, the one group with a vested interest in telling us why our thesis is wrong. Before we bought used car retailer CarMax in 2001, we went through Sunday newspapers from every market they're in and visited car dealers advertising against them in the paper. We'd describe how CarMax was going to inexorably take market share, and the local dealer was eager to argue why that was wrong. I'd much rather hear why our thesis might be wrong at this point than for the market to tell us after we own the stock. Boykin Curry, Eagle Capital. One thing we try to do in industry due diligence is to find the guru. Getting to the truth can really be accelerated by finding the handful of folks who truly understand a business or industry. A deep database of relationships with industry experts is a key value add to that process. Jeffrey Tannenbaum, Fir Tree Partners. Because of digital technology, information flows much faster and in greater volume. That doesn't mean the information is better. Misinformation travels faster too, but there's more to digest and synthesize. Morris Mark, Mark Asset Management. We work very hard to get as much information as possible, but it's hard to win the information arms race. There are always people who will know things you don't. Investing is about the conclusions you draw from the information you have. Just because someone speaks to 7 store managers instead of the 5 we speak to doesn't mean they'll make a better investment decision. People in industries have as many or more biases than investors do, and often draw circular conclusions. For example, the company is bad because the stock is bad. We focus on uncovering information that helps us understand the probabilities of what can happen. Beyond that, too many opinions can often confuse things more than help. Brian Gaines, Springhouse Capital. We've had bad experiences where we've tried to do scuttlebutt research, such as overweighting anecdotal evidence given to us by someone in the value chain. We've also overweighted a toxic response to the current management team when we shouldn't have. For us, and for most people, it's very hard not to overvalue information that you think you get from some kind of specialized source. We try to keep that in perspective. When the investment decision hinges on 1 or 2 critical questions, and you can get those questions answered if you make some phone calls, we'll clearly make the calls. But most of our ideas aren't like that. Zeke Ashton, Centaur Capital. As the saying goes, the plural of anecdote is not evidence. Michael Mauboussin, Legg Mason Funds. I love the intellectual challenge of investing. There are always new questions to try to answer, but it's important to remember that you don't actually have to answer all the questions you ask yourself. It's like being able to take a test in school where you can answer any 10 questions of your choice on a 100-question test. You answer only those you know well and ignore those that are very difficult to answer. That's what investing is all about. Murray Stahl, Horizon Asset Management. Organizing Principles. While they spend much of their time critiquing how other businesses are run, money managers have their own businesses to run as well. Not surprisingly, they typically have strong views on how to best organize and manage their research and analytical functions. One common decision point is the extent to which research analysts are generalists who look everywhere for ideas, or specialists focused on specific industry sectors. Also frequently addressed is the environment created around the research and analytical process, how team members are selected, and how they're meant to interact. We break the world into geographic regions, but within those regions we want our analysts to be generalists, looking across all industries. Part of that is so people can apply a broad knowledge of business models, industries, and markets to every company they analyze. It also allows people to more naturally gravitate to where the opportunity is right now. If you're a generalist, you can more easily ignore banks if they don't look interesting, while the bank expert will inevitably find one bank or another they want to buy. As Charlie Munger says, to the man with a hammer, everything looks like a nail. David Samra, Artisan Partners. We like being generalists. We haven't owned any healthcare for more than a year, but nobody feels like they have to push healthcare ideas or that their bonus is threatened because they're the person focused on healthcare. Ideas rise to the top only on their merits. Christopher Grisanti, Grisanti, Brown and Partners. Given that what we're looking for is clear and has been consistently applied, we can give our analysts a great deal of freedom in identifying and pursuing ideas. They know that if they can't explain why something is at a discount to value, why that value is going to grow, and why we should be comfortable with management, they just don't bring that idea to the table. While what we're looking for is tightly constrained, we don't constrain where analysts can look. If two people want to pursue an idea, regardless of the industry, that's fine. Is it a waste of resources when two people find something interesting, when that probably means it actually is interesting, and that the two of them are working it out together makes it more likely we arrive at the right conclusion? Bill Nygren, Harris Associates. We have a total of 7 analysts, including myself, and we believe when investment teams have more than 10 people, they start to break down. Egos get in the way. People start to specialize, and you just can't have the quality of collective discussion we think is necessary. Pat English, Fiduciary Management Incorporated. Our portfolio managers are also analysts, with all coverage responsibilities segmented by industry up and down the market cap spectrum. There's leverage in bringing what you already know to an incremental new idea. If I'm looking at a small-cap software firm, I should have a good sense of the competitive environment, for example, including what Microsoft, Oracle, and SAP are doing in the area. If I'm looking at Microsoft, I should know its strengths and weaknesses as well as the new technologies it's up against in any given market. A generalist, having to learn things like that for the first time, may not recognize change and opportunity as quickly. We're cognizant of the risk that people lose sight of the forest from the trees, so each analyst covers 2 very different industries. I cover software and machinery. Someone else follows healthcare and energy. This should make us less likely to lock on to one way of thinking and less apt to recommend the best house in a bad neighborhood just because it's where we live. Reagan Steinke, Westwood Management. In an ideal world, I'd like to be more selective in the U.S. and take advantage of more opportunities outside the U.S. That will only happen if we have the bottom-up ideas that warrant a place in the portfolio. To increase our chances of finding those, we've changed how we organize our international efforts. I used to think it was more important to have individual sector team members in the same office so they could more easily learn from each other and compare notes. Now we're putting more people on the ground, closer to the companies they track, in order to improve the quality and frequency of their external relationships. Lee Ainslie, Maverick Capital. An extensive knowledge of a business improves your ability to recognize patterns and draw useful insights, a prerequisite to having an investment edge. Beyond that, I'd argue that expertise is critical when things inevitably happen and you either need the conviction to stick with your thesis or the wisdom to recognize that it's changed and react accordingly. Stepping outside of areas we know well just seems too much like dancing through a minefield. Sean Kravitz, Esplanade Capital. If I believed having 10 people rather than 52 would allow us to be more successful, we'd quickly make that transition. But with the specialization of the people we're competing against today, I think it's very difficult to have a meaningful edge without significant depth and expertise. We should know more about every one of the companies in which we invest than any other non-insider. Consistently picking winners and losers requires extremely in-depth knowledge of operating businesses and the industry dynamics. That takes work. Lee Ainslie, Maverick Capital. We recently read Groupthink, Irving Janis's classic study of how small, cohesive groups of very smart people can make really bad decisions, such as getting deeper into Korea, the Bay of Pigs, and Vietnam. The main point is to make sure you have a culture that questions everything and vets out all the decision alternatives before zeroing in on one of them. One of the personal insights I gained from the book is the value of playing one's cards a bit closer to the vest early in the decision-making process. I have a habit of speaking my mind all the time, but in the earlier stages of research that can set a direction that I and others may unconsciously anchor on, closing off a fuller exploration of alternatives. The last thing you want to do is shut down people's initiative. Adam Weiss, Scout Capital. My analysts are now saying, I know you're going to hate this, but that's a great thing. If my initial reaction is to hate it, so is the market's, and that probably means it's something we should look at more closely. Jeffrey Bronchick, Cove Street Capital. There's a virtuous cycle in people having to defend challenges to their ideas. Any gaps in thinking or analysis become clear pretty quickly when smart people ask good, logical questions. You can't be a good value investor without being an independent thinker. You're seeing valuations that the market is not appreciating. But it's critical that you understand why the market isn't seeing the value you do. The back and forth that goes on in the investment process helps you get to that. Joel Greenblatt, Gotham Capital. At our Tuesday meeting, an analyst will give us a short summary of why he believes the idea meets our criteria, and then everyone around the table tries to shoot holes in it and prove that he's wrong. You have no friends in that meeting. Everyone is trying to prove that you're making a mistake. We're trying to identify as high a percentage of our errors as possible before we've lost any money on them. Bill Nygren, Harris Associates. I refer to our investment committee meetings as Fight Club, but there's a respectful way of valuing your colleagues while at the same time questioning every word that comes out of their mouths. Adam Weiss, Scout Capital. We have 3 analysts, including myself, and for every idea we pursue in depth, 2 of us will make the purchase case and 1 makes the case for selling the stock short. There are behavioral biases that can kick in when you pursue what you think is a good long idea, and by expressly tasking one person with developing what the intelligence community calls the alternative competing hypothesis, we're looking to minimize the risk of missing something. We want to be clear up front about what could go wrong, the probabilities attached to those scenarios, and the resulting downside to the stock as a result. Jeffrey Bronchick, Cove Street Capital. A major risk management step in our research process is a peer review within our research groups. After an analyst works up an idea, he or she presents it to the others in the group, who evaluate and challenge all the downside and upside assumptions being made. While they may not know the specific industry or company, they will likely be quite current on the business models and fundamental drivers of the business. We like to say it's a lot easier to crawl out of a hole if you stop digging early. Here, we're bringing as much collective wisdom to bear as we can to keep us from even picking up the shovel. Reagan Steinke, Westwood Management. The risk among any group of investors is that they only pay attention to what they already agree with. That's limiting and dangerous. Michael Mauboussin, Legg Mason Funds. Always ask yourself, what are the arguments on the other side? It's bad to have an opinion you're proud of if you can't state the arguments for the other side better than your opponents. This is a great mental discipline. Charlie Munger, 2006 Wesco Annual Meeting. Tiger Management founder Julian Robertson was always adamant about seeking out the opposite point of view and then being completely honest with yourself in deciding whether your analysis overrides that. That's something we try to practice every day. Robert Williamson, Williamson Macquarie Investment Partners. In markets, everyone tends to see the same things, read the same newspapers, and get the same data feeds. The only way to arrive at a different answer from everybody else is to organize the data in different ways, or bring to the analytic process things that are not typically present. One research source of ours is a firm in Hong Kong called GaveCal, which has a regular feature they publish called What We See and What We Don't See. They say, here is what we see, namely all the data everybody else sees, but now, here's a systematic look at relevant things people are not talking about, what they're not thinking about, what the other side of the issue might be. That's very important. Bill Miller, Legg Mason Funds. We pay a lot of attention to dotting our I's and crossing our T's when it comes to the fundamentals of finding opportunities that are safe, cheap, and good, because we think it makes it easier to reframe things in new, flexible ways. One problem with value investors is that they can often become ideologues, but there's a big difference between focusing on the basics and being an ideologue. We found that you have to constantly challenge your ways of thinking and re-educate yourself to remain successful as an investor. Mitchell Julis, Canyon Capital. The last step in our research process is to invite a Wall Street analyst who is a bear, and they come in and make a pitch why we shouldn't buy this stock. We want to see if the reason they don't like it is if they see a real structural flaw in the business that we didn't pick up on, or if it's just they don't know what's happening. Most of the time, they're negative because of no earnings visibility, which is Wall Street language for I don't really have a clue what's going to happen next. Richard Pazina, Pazina Investment Management. I guess it was my good fortune to work with several egomaniacs during my career, and I promised myself that when I started my own business that I'd create a much different environment than what I'd experienced. It wasn't going to be all about me, and we weren't going to treat people like commodities. We try to have an inclusive environment and treat people well and with great respect. Barry Rosenstein, Jana Partners. It's important to realize that the brain isn't programmed like a computer, and that every individual can approach problems and issues in a unique way. Even at my age, I try to remain flexible and open to new ideas and ways of approaching things. That keeps me from becoming a frustrated pedagogue and also allows me to get more from the individual strengths of the people who work for me. Spencer Davidson, General American Investors. We evaluate ourselves on rolling 5-year periods. If a portfolio manager has one great year, it doesn't factor at all into how he or she is paid. That could just be a random event. I think it's actually a stretch to say 5 years is long enough to be relevant, but I realize not everyone has the same time frames. Rick Dillon, Diamond Hill Investments. I do not hire people I would not want as friends or as neighbors. I work with people who make my life easier. You can't work with people who make your stomach grind. Warren Buffett, 2005 meeting with Wharton students. I really think that we benefited from starting with good young people who begat more good young people. We eventually devised testing that all applicants had to take. We still give that test, which takes about 3 or 4 hours. It is part aptitude, but also psychological. It sort of emanated from our having a few people over time who just didn't have the firepower to do the job. It's tragic when that happens because it's not their fault, so we designed these tests to better avoid that. The test was also designed to show what kind of team player the person was and their competitiveness. I found that most good money managers are great competitors. I think that all helped us pick good people. Whether it helped as much as having great young people recommending more great young people, I don't know. Julian Robertson, Tiger Management. It's important to hire people with diverse experiences and viewpoints, which you don't necessarily get if you just hire straight-A Harvard MBAs. Getting good grades and having courage are not the same thing. Being really smart and having good judgment are not the same thing. No one should be winnowed out so early in life. Susan Byrne, Westwood Management. We have in the past hired smart young analysts right out of business school, but have concluded that's not for us. We're looking for people who've been around long enough to know who they are as investors and the type of environment in which they do their best work. They're not still trying different approaches on for size. If you want to maintain a research-driven, collegial, and long-term oriented culture, there's no better way than by only hiring people who share those values. Whitney George, Royce & Associates. It's wonderful to be trusted. Some think if we just had more compliance checks and process, virtue would be maximized. At Berkshire Hathaway, we have a subnormal process. We try to operate in a web of seamless trust, deserved trust, and try to be careful whom we let in. Charles Munger, 2007 Wesco Annual Meeting. Chapter 7. Getting to Yes. A long-ago mentor, in a business other than investing, used to like to make one of his favorite points by describing how he could create the most popular restaurant in New York City. He would hire the best real estate experts to identify the ideal location and then pay whatever it took to acquire the property. He'd spare no expense in hiring world-class architects and designers to build out the place with only the highest quality materials, fittings, and furnishings. He would staff and outfit the kitchen under the direction of chefs who he had poached from the world's finest restaurants by allowing them to name their price to come on board. Once the doors opened, he'd offer 4-course prix-fixe menus, including wine, for $9.99 each, with tips and valet parking included. "Voila! New York's hottest restaurant is born," he'd say. An extreme example to be sure, but the point stuck. Business is all about what you pay for what you get. If costs to produce are too high relative to what you are paid, no matter how sublime the product or service, you will ultimately fail. The same basic principle applies to investing. Through creative and diligent research, you may uncover fascinating companies and wonderful industries. Through brilliant and incisive analysis, you may see unfolding for a company positive events that mere mortals would miss. But all of that is for naught if you pay too much for a stock relative to what you get. Price obviously matters. The cheaper it is relative to what you believe a company is worth, the better. This section is about how smart investors conclude whether the price they're paying for a stock is sufficiently cheap relative to the value they believe they will receive through their resulting partial ownership stake in the company. While there are clearly common elements in how investors ascribe value, we've been struck over time by the variety of valuation measures they utilize and how they approach and answer the question, what's cheap enough? Cash flow is king. There are some prevalent themes in how smart investors approach valuation, the primary one being their focus on the future stream of actual cash that the company is expected to generate after taking in all revenues and paying out all expenses. It has always made sense to me to rely far more on cash flow than reported earnings. When I was in graduate school, my brother-in-law hired me to do some temporary work at a canning company. One project was to go through a pile of invoices and pull out anything that looked at all like a capital purchase, even for things like tires and other pretty basic recurring expenses. I finally asked why I was doing that, and he said the CFO wanted to capitalize anything that remotely looked like capital spending so they could write it off over time. The lesson for me in that was that a clever accountant can make financial statements say whatever he wants in the short term. That conclusion has only been reinforced over time, especially as the differing tax regimes and accounting conventions you see overseas can make comparisons based on reported net income even more meaningless. David Harrow, Harris Associates. Earnings are basically a negotiated number between management and the auditors, subject to considerable manipulation. Cash flow, earnings before depreciation and amortization and after working capital changes, and either maintenance or total capital spending, is much less subject to manipulation and just a much better measure of corporate profitability. At the same time, free cash flow is what allows companies to increase the value of the business, from making capital investments to making acquisitions to paying down debt to buying back stock or paying dividends. Companies that produce free cash flow also attract potential buyers, either financial or strategic. John Osterweiss, Osterweiss Capital Management. We ask what our expected rate of return would be if we owned the whole business, which is essentially taking pre-tax free cash flow and dividing it by the current enterprise value. For pre-tax free cash flow, we look at normal earnings before interest, taxes, depreciation, and amortization, less maintenance capital spending. In the denominator, we adjust enterprise value by adding contingent liabilities and subtracting any kinds of hidden assets we find. If, after all adjustments, we can see mid-teens rate of return, we're very interested. Steve Romick, First Pacific Advisors. We've always done very well when we can use 6th grade math on the back of a postcard to show how inexpensive something is relative to its free cash. Once we start getting more sophisticated, trying to prove something rather than see if we can disprove it by killing the business, we get into trouble. We're looking to pay 10 times free cash flow or less, period. If you find those and you can't kill the business, you should be buying all day long. Bruce Berkowitz, Fairholme Capital. We want to see at least a 10% free cash flow yield and a 6 times or less multiple of enterprise value to next year's earnings before interest, taxes, depreciation, and amortization, EBITDA. For enterprise value, we use the current market value plus the estimated net debt 12 months out. Most of the companies in our universe generally live within a range of 6 times to 8 times EBITDA. The idea is to identify companies having some earnings or other trouble that leave them trading at the low end of the valuation range. If our analysis is right, that the difficulties are temporary, we get 2 boosts. From earnings recovering and from the market reacting to the earnings recovering and moving the multiple to the higher end of the range. We believe that dynamic gives all our core positions a very high probability of at least a 50% return within 2 years. At the end of the day, we're trying to buy companies as if we were buying a $10 million office building across the street. We do our homework on the tenants and the leases in place and make sure it's financed in a way that produces a 10% free cash flow yield. The idea is to increase equity by paying down debt with the free cash flow, and also to benefit from the asset appreciating over time. With stocks, if you focus on companies with around 10% free cash flow yields and highly predictable, sustainable franchises, you protect your downside and set yourself up for nice capital appreciation. Alexander Ropers, Atlantic Investment Management. Our valuations are based on estimated EBITDA 12 to 18 months out. We don't look out further because we have little confidence in our ability to forecast beyond that, and because we're most interested in what the business is worth today. The art in the valuation is arriving at the appropriate multiple to put on the cash flow. We look at private market transactions and public comps, adjusting up or down from those based on things like the profitability of the business, its predictability, the prospects for growth, and the amount of leverage. James Shercliffe, River Road Asset Management. We look at the securities analysis part of what we do in the way people look at valuing a bond. Ignoring the maturity date, what you need to know is the price, the coupon, and the reinvestment rate. It would be crazy to value a bond knowing only two of those things, and we look at stocks the same way. For price, we look at enterprise value, because you need to take into consideration all the calls on the earnings that are senior to you as an equity holder. We also try to mark the balance sheet to market by adjusting for things like underfunded pensions or real estate on the books at cost. As a coupon, we're looking at owner earnings, which adjusts GAAP earnings to arrive at the cash flow you'd have at your disposal as an owner. There are many adjustments to make, but the most important is accounting for the difference between the inflation-adjusted amount of capital a company spends to maintain its competitive position compared to its reported depreciation levels. The third key item is the rate at which owner earnings can be reinvested. This is the hard part, but obviously enormously important to any investment thesis. If you look out 5 to 10 years, as we typically do, that return on incremental capital is going to be far more important than the earnings yield you get in year one. That's why the business analysis is so important. Christopher Davis, Davis Advisors. What gets our interest is when a target company's share price goes down to the point where the free cash flow yield, EBITDA, minus real capital spending, minus incremental working capital divided by enterprise value, is at least 10%. The reason we have to do at least cursory work on 100 companies per year is that it is really hard to find 3 or 4 that, in addition to the 10% free cash flow coupon, can also generate growth in free cash flow of at least 10% per year. In most value situations, too much of the company's revenue is tied to mature and oftentimes declining product lines. But when we can see 6 to 8% organic growth combined with margin gains, producing double-digit free cash flow growth, that's interesting. If we can buy 10% current coupons, and if the coupon grows at 10%, the math says we will generate an annual 20% unlevered return. That's the target for each position we hold, and it's what we expect out of the entire portfolio. Jeffrey Ubben, Value Act Capital. We're trying to own things that look like value stocks when we buy them, but which turn out to be growth stocks. So we try to build a portfolio of businesses with 2 primary characteristics. The first is that, even in times of stress, the underlying income-producing assets are strong enough to maintain a value floor for the investment. In other words, the company is cheap based on what we can be fairly certain of now. The second characteristic is some change going on that is unrecognized by the market and likely to be very valuable in the out years. A free call option. We generally want to invest at a price where if our growth thesis is totally wrong, we can still expect to earn at least an 8% nominal cash-on-cash return. That's roughly in line with what the overall market is likely to return, so we would match that even if none of the free options pay off. Boykin Curry, Eagle Capital. The first thing we do is normalize what we think the company's earnings power is. A lot goes into that, but it essentially means looking at what the business has traditionally been able to generate over time and adjusting for various factors that might make it more or less attractive going forward. We then estimate the percentage of those normal earnings that the company will keep after things like capital spending and investments in working capital, resulting in a free cash flow number we can divide by the current market value to get a free cash flow yield. On top of that, we'll add inflation and the annual growth rate in free cash flow we expect in order to arrive at our estimated rate of return, which we typically want to be at least in the teens. By focusing on forward rates of return, it keeps us more centered on the fundamentals of the business and its cash flows. We aren't counting on or trying to figure out what someone else might pay as a P/E or cash flow multiple down the road. Stephen Yachtman, Yachtman Asset Management. The metric we care about most is what we call reinvestment cash flow, which is essentially earnings before interest and taxes, plus depreciation and amortization, minus maintenance capital spending. We look out 3 years and want to see the reinvestment yield the company earns increasing relative to its enterprise value. Then, using a discounted cash flow model, we calculate a warranted value that has to be at least 50% greater than the current market price. Joe Wolf, RS Investments. We're primarily focused on free cash flow yield, which, after taxes and maintenance capital spending, we want to be at least 8 to 10%. For faster-growing companies, we accept a bit less, but that's the general guideline. We tend to look at valuation in layers. The first layer is a sort of no-growth, as is valuation, based on historical performance and how we believe free cash flow will respond going forward to a few key variables. The second layer looks at the free cash flow yield after incorporating operational improvements we expect that don't require top-line growth. Finally, we build in the opportunities for revenue growth we see. Our goal is to be satisfied with the yield we'd get based on the first layer, but obviously the thicker the layers are, the better the opportunity. Good things can happen when competent people are working every day to improve a high-quality company's performance, which we usually look at as free options on the upside. It's maybe a bit boring, but our objective is to compound at a minimum of 10% per year. You do that over 20 years, and you increase capital by almost 7 times. That's rare enough that when people actually do it, you're likely to hear about it. Patrick McNeil, Allitus Capital. We're essentially willing to pay for the current cash earnings power. It varies, but if we're paying a price that results in at least a 7% maintenance-free cash flow yield, we believe we're paying only for what's being generated today, getting for free the ability of the business model to grow free cash flow at a rate significantly ahead of the market. We look to make money in a couple of ways. The first is through compounding of the company's intrinsic equity value at 20% or more per year. Secondly, if we're right in identifying this type of business earlier than other investors, we should get paid over time from multiple expansion as well. Jörg Diedrich, Pennant Capital. It's not exactly reducible to a bumper sticker, but the key to our approach is free cash flow total return. We look at free cash flow yield plus expected growth in free cash flow compared to the market implied rate of return. Take Amazon. The free cash flow yield is around 5%, but the free cash flow growth rate is 20 to 25% easy. So that's a 30% free cash flow total return versus, at most, the 8 to 10% you'll get on the overall market. Our view is that it doesn't take a mathematical genius to figure out that 30% is going to be 10% if you have any time on your side. Bill Miller, Legg Mason Funds. Basically, we have to answer 3 questions. Is the stock mispriced? Why is it mispriced? And what's going to make the mispricing go away? If we can't adequately answer those questions, we either haven't done enough work or it's probably not a great idea. To answer the first question, we arrive at a fundamental value for each company we analyze, which is essentially the price at which its cash flows or asset values provide an adequate, risk-adjusted cash-on-cash return. For a moderate growth business with moderate leverage and a normal interest rate environment, that return over time would be roughly 15% per year. Against that fundamental value, we typically want our shorts to be at least 30% overvalued and our longs to trade at a 30% discount or higher. Curtis McGwen, Ivory Capital. I've always believed that as an investor you have to be comfortable with a number of different valuation approaches and methodologies, and part of the art of investing is to recognize which approach is most appropriate in different situations. The metric we tend to look at most frequently is sustainable free cash flow yield. In other words, free cash flow after the capital spending necessary to maintain a company's competitive position relative to the current market price. Across most businesses, we consider that a consistent, important measure of value. Lee Ainslie, Maverick Capital. Multiple angles. While some measure of cash flow relative to the current market price is the most common valuation metric used by leading value investors, they frequently utilize a number of additional measures of value in forming their judgments. This approach has strong research support, including that of Wall Street Works on Wall Street author and money manager James O'Shaughnessy, whose multi-decade research indicates that stocks that screen well on a composite of value-based factors, including price to book, price to earnings, and price to cash flow, perform much better over time than those screening well on any one individual factor. We try to use multiple methodologies to establish a company's intrinsic value: discounted cash flow models, private market values, and market-based multiples compared to peers and the company's own history. We think coming at it from multiple directions can give us a higher level of confidence in our ultimate estimate of value. Timothy Beyer, Sterling Capital Management. We don't buy if we don't see a 35% discount to our current estimate of intrinsic value, which we arrive at in a variety of different ways depending on the company. Ideally, we're running a discounted cash flow model, cross-checked against where we believe something should trade based on other metrics like price to earnings, price to cash flow, price to net asset value, or a sum of the parts. We think at least a 35% discount gives us enough margin of safety that we can be wrong and not get killed. Steve Morrow, New South Capital. The metrics we use to determine value are pretty much what you'd expect. We do private market value analysis using discounted future cash flows and by looking at breakup values. At the same time, we like stocks that are statistically cheap on a traditional price-to-earnings basis. We focus on companies trading at 40% or greater discount to our private market value, or no more than 13 times our estimate of next year's earnings. We have to have one or the other to buy. John Rogers, Ariel Investments. We like looking at multi-segment businesses where it's a bit more complicated to analyze all the parts, and there's not an obvious answer to the question of what the entire company is worth. In this context, we pay a lot of attention to private market values of each segment and trying to understand how underperforming segments should be valued. Peter Langerman, Mutual Series Funds. We'll estimate what we think the earnings can be 4 to 5 years out, apply the current multiple to those earnings, and then see what the price would be if discounted back to today using a 20% annual rate. If the price today implies a discount rate of more than 20% per year, we're interested. We're not even looking at what we think can happen next year, because that's already fairly accurately built into the stock price. We also don't usually count on multiple expansion, although it would be great if it happened, because you really can't estimate a multiple 5 years out unless you have a good idea what interest rates will be then, which is not something I know anything about. Murray Stahl, Horizon Asset Management. The Informed Buyer. Value investors from Benjamin Graham on down have stressed the importance of looking at equity ownership not as the shuffling of papers to be traded, but as a partial ownership interest in an ongoing business enterprise. A logical extension of that, in arriving at what a stock is worth, is the frequent focus among accomplished investors on what they believe a knowledgeable buyer would pay for the entire business. In ballpark terms, we like to be a buyer when the current share price is no more than 60% of our estimate of business value, which is the highest price a cash acquirer could pay for the entire business and still earn an adequate return on their investment. The words are all important. By focusing on a cash buyer, we're trying to separate people who are paying real money from those who might overpay with their own overvalued shares. The focus on adequate returns allows for the possibility that the buyer has some way to extract synergy from the purchase. Especially when you're looking at small to mid-cap companies, the maximum value may come from a buyer who will integrate the business into a larger organization. We're not just looking at the maximum price of a given company in its current corporate form as a public entity. Why 60 cents on the dollar to buy rather than 50 or 40? Over long periods of time, stocks tend to perform better than other assets do, and the more stringent you are about what you'll accept, the more difficult it becomes to field a portfolio. We found over our history that at 60 cents on the dollar, we've been able at any given time to field a relatively full and well-diversified portfolio of ideas. If we buy right, the discount closes, and the value of the dollar we buy today goes to $1.20 or so over the next 2 or 3 years. We have the potential to double our money. That kind of makes sense to us. Bill Nygren, Harris Associates. Intrinsic value to us means the price that a knowledgeable buyer would pay for a business is its entirety in cash today. Any knowledgeable buyer will recognize and take into consideration whether current earnings are too high or too low, based on the cyclicality of the business and where it is in the cycle. Similarly, we don't want to capitalize earning streams that are too high or too low, but focus in valuation on what the cash flow of the business is somewhere between the extremes. Because the future is uncertain, we don't exaggerate the precision of the values we come up with. Abhay Deshpande, First Eagle Funds. We try to figure out what a rational, informed buyer would pay for the whole business. We'd expect that kind of buyer to base the price on how much cash the business would generate over the next 15 to 20 years, in excess of what's needed to run the business, so true free cash flow. We use a standard 12% discount rate as the hurdle rate that buyer would want to earn. Wally Weitz, Weitz Funds. In general, we want to see a 35 to 40% discount from what a prudent man making an acquisition would pay for the entire business. We put it that way because sometimes, such as in 2006 and 2007, acquisitions are being done at levels we consider imprudent, so we don't use them in calculating intrinsic values. If you're fairly conservative in valuing the business and then demand a 40% haircut off of that, you should have a pretty healthy margin of safety. Robert Wyckoff, Tweedy Brown Company. We basically focus on what a somewhat knowledgeable buyer, expecting a reasonable return, would be willing to pay in cash for the entire business. We put a lot of emphasis on comparable transaction and market values, cross-checked against valuation measures like enterprise value to EBIT. We'll generally only invest when the EV to EBIT multiple is in the range of 8 times to 15 times, the low end for businesses. Using Warren Buffett's terminology, that might be more questionable, while the high end is for businesses that are more comfortable. Jean-Marie Eviard, First Eagle Funds. We're not P/E buyers. We're not P/E to growth rate buyers. And we're not EV to EBITDA buyers because we think over time that the D and A in EBITDA are real expenses you need to account for. We look at current operating income divided by enterprise value as our cap rate, and we want to buy when that's 15% or more and sell when it goes to 7 to 8%. I'm trying not to buy hopes and dreams, but the here and now. The layman's way to think about it is if you could buy the whole company and, before financing and paying taxes, earn 15 cents on a dollar invested, that's a pretty good deal. If the hopes and dreams come true, all the better. J. Kaplan, Royce & Associates. The underlying principle is what someone would pay in an arm's-length transaction for the entire business. We usually arrive at that by applying what we consider to be the appropriate multiple to estimated EBITDA 1 year out, adjusted for the balance sheet. To enter a position, we want to see a 30 to 40% discount to our intrinsic value estimate. We try not to fool ourselves that just because we built a spreadsheet that all of this is very precise. We're making estimates and thinking about things that are unknown. But there are cases in which our level of confidence in the estimated earnings or in the multiple is higher. The more confident we are, the more likely we'll find a 30% discount sufficient. The less confident we are, the higher the discount required. In our experience, a portfolio of stocks with those types of entry points will generate an attractive return over time. We will not be right on every stock. We just need to be right on average. Andrew Jones, North Star Partners. Model behavior. In the investing world writ large, there is an extremely wide variance in the extent to which money managers automate their valuation, assessment, buying and selling decisions. At one end of the spectrum are those who rely heavily on discounted cash flow models and other defined valuation parameters to drive portfolio decisions executed by computer algorithms that respond to changes in market prices. At the other end of the spectrum are investors with a decidedly healthy skepticism of computer models and the certainty and precision that they imply exists. Most of the investors we interviewed fall somewhere in the middle, rigorous in their use of models to assess valuation and make trading decisions, but also relying on experience and intuition to overrule the system when they believe it's warranted. As we've said many times, there is no one right approach, but every successful investor we've come across is quite adept at describing where automation ends and intuition begins in his or her approach. Models beat human forecasters because they reliably and consistently apply the same criteria time after time. Models never vary. They are never moody, never fight with their spouse, are never hung over from a night on the town, and never get bored. They don't favor vivid, interesting stories over reams of statistical data. They never take anything personally. They don't have egos. They're not out to prove anything. If they were people, they'd be the death of any party. People, on the other hand, are far more interesting. It's far more natural to react emotionally or to personalize a problem than it is to dispassionately review broad statistical occurrences, and so much more fun. It's much more natural for us to look at the limited set of our personal experiences and then generalize from this small sample to create a rule of thumb heuristic. We are a bundle of inconsistencies, and although this tends to make us interesting, it plays havoc with our ability to successfully invest. James O'Shaughnessy, O'Shaughnessy Asset Management. An ideal stock, according to our model, would be inexpensive on an absolute basis, relative to its peers and relative to its history. It would be supported by high-quality earnings, as measured by things such as cash flow relative to net income, capital spending relative to depreciation and earnings estimate dispersion. It would be financially secure, as measured by things like the levels of cash and operating cash flow versus liabilities, the operating return on assets, and the ratio of shareholders' equity to total assets. Finally, it would be in the midst of an upswing in business operating momentum and investor sentiment, as indicated by, say, share price momentum and earnings estimate revisions. Paul Vazolis, Wedge Capital. We have a sophisticated proprietary model that we have shown to be a source of alpha by valuing companies and judging where they are in their earning cycles. That's the science of what we do and is quite systematic and repeatable. The art of what we do is in the interpretation of that data and deciding what to actually buy and sell. Here you need to rely on experience, judgment, and continuous learning. Is that repeatable as the people change? If you pick the right people, teach them well, and give them the experience necessary to act on their own, we think so. Ronald Mushak, Systematic Financial Management. With our quantitative and more automated approach to buying, we're just trying to take as many of the behavioral foibles off the table as possible. Think about it in terms of the S&P 500 index, which is actually a not-so-great investing strategy because all it says is buy big stocks. The reason it beats 70 to 80% of conventionally managed funds is not because it's a good strategy, but because it's a strategy that's religiously adhered to. It doesn't panic, have second thoughts, or become jealous of what its next-door neighbor index owns. The key to its long-term success is an unwavering implementation of an investment strategy. We're using the same logic, but with what we believe are better strategies. James O'Shaughnessy, O'Shaughnessy Asset Management. To arrive at an intrinsic value, we forecast cash flows out 5 years and then discount the first 4 years back to the present and add to that the present value of the 5th year's cash flow after applying a multiple to it. The setting of that multiple, of course, is very important and is where we have the most debates in our approval process. There are quantitative and qualitative aspects to it. We'll maybe start with peer multiples or the multiples at which deals have been done, for example, but that's not the only input because every company is different. We also take into consideration things like the consistency of the business, its financial strength, and the operating prowess of the management team. David Harrow, Harris Associates. We're trying to find 20 to 30 long investments run by management teams that truly understand the cost of capital and capital allocation, where we believe, based on a dividend discount model, that we're paying 60 to 70 cents on the dollar today, and that dollar can grow at an equity rate of return. If you can buy a 60-cent dollar and over 3 years that dollar appreciates 10% per year and the discount closes, the stock will more than double. You obviously won't do that on every position, but if you hit that on half your positions on average and don't lose any money on the other half, you'll earn 13 to 14% per year. John Jacobson, Highfields Capital. Our discounted cash flow calculation then produces two prices. Our buy price is the price at which the cash flows are being discounted to produce our required real return of 8%. Basically, the company is priced low enough to allow us to earn in excess of the market's expected return. Our sell price is the one that discounts future cash flows at 6%, meaning the valuation no longer allows us to earn an expected return greater than the market's. Bernard Horn, Polaris Capital. Our goal is to create a detailed financial model that estimates cash flow available to shareholders over the next 5 years. With that model, we're able to calculate the present value of both the 5-year cash flows and a terminal share value, calculated by applying an estimated terminal multiple to our 5-year cash flow estimate. We discount both those values back to the present using a required rate of return, which reflects the riskiness of the cash flows due to things like industry cyclicality, competitive threats, and the rate of technological change. In today's interest rate environment, required rates of return for most companies we analyze are from 8% to 12%. Chris Bingaman, Diamond Hill Investments. We do the same discounted cash flow analysis everyone does, but the most important variable, and the one that most impacts the answer, is the growth rate you assume for the business. Lee Cooperman always used to say that if you got that right, you were 90% there. I've always considered that to be true. Morris Mark, Mark Asset Management. If you're buying high-quality businesses at what you think are discounted prices, you can be a little bit wrong on your intrinsic value estimates and still make money. If you've ever done DCF analysis, you know how variable the results can be with small adjustments in things like operating leverage or discount rates. We want to buy only when the share price is 50 to 60% of our calculation of intrinsic value. But our qualitative judgment of the business, management, and risk involved will play a bigger role in the positions we take than whether the stock is at 58% of intrinsic value and this other one is at 54%. Brian Bears, Bears Capital. We're not big fans of DCF models because of the garbage in, garbage out risk. I don't know if lunch will be good later on today, so how am I going to forecast a company's earnings 5 or 10 years out? Most of our valuation work focuses on what a company would be worth today in an arm's-length transaction. The best sources for that, of course, are comparable recent deals. We also look at how valuation multiples on a given company or the sum of its parts match up against historical and competitive comps. David Winters, Wintergreen Fund. We try to avoid false precision when we do our valuation work. We don't know what earnings are going to be next year, and we don't believe management teams themselves can know that with any great precision either. What we can try to do is estimate the normalized economic earnings power of a business and then put a reasonable multiple on those earnings based on the characteristics of the business, that is, growth, need for capital, competitive position, and relative to what's happening out there in the real world of mergers and acquisitions. Curtis Jensen, Third Avenue Management. I'm still more back of the envelope when it comes to valuation. To me, it all comes down to the assumptions you're making. If they're correct, a back of the envelope calculation works perfectly well. If they're not, sophisticated modeling isn't going to help. Robert Kleinschmidt, Tocqueville Asset Management. I was brought up in the business to be skeptical of big, long-term discounted cash flow models, so that's not an important part of how we invest. Stephen Tannenbaum, Golden Tree Asset Management. Discounted cash flow to us is sort of like the Hubble telescope. You turn it a fraction of an inch and you're in a different galaxy. There are just so many variables in this kind of analysis. That's not for us. Curtis Jensen, Third Avenue Management. Playing the odds. Consistent with value investors' emphasis on what can go wrong with any given investment, they typically in their valuation work assess a variety of possible upside and downside value scenarios and, implicitly or explicitly, assign probabilities to each before making any final judgments. We're very focused on how much money we can lose. What's the hard asset value? What protection does the balance sheet provide? We stress test the business using draconian assumptions and compare the worst-case scenario with what we predict will actually happen. We want $4 to $5 of upside for every $1 of downside. We found over time that if you marry improving returns on invested capital with an asymmetric risk profile, the odds of losing money are low. Joe Wolf, R.S. Investments. I'll say it in a way that implies more precision and rigidity than we use, but we also want to see potential upside versus downside of at least 3 to 1. If, at normalized earnings levels in 2 years or so, we see an upside that is 3 times the downside we could imagine in the next year or so, we're usually comfortable going forward. Stephen Romick, First Pacific Advisors. The prospective return must always be generous relative to the risk incurred. For riskier investments, the upside potential must be many multiples of any potential loss. We believe there is room for a few of these potential 5 and 10 baggers in a diversified, low-risk portfolio. Seth Klarman, The Baupost Group. One lesson from 2008 was that we were guilty of having a failure of imagination on the downside. We develop a base, high, and low case for each business we analyze, and one practical adjustment we've made is to make our low cases somewhat more draconian. That comes into play in what we're willing to pay. We're more reluctant to buy a stock that might look attractive relative to the base case if the downside from the low case is too great. That's always been true. If the range of outcomes is wide, that probably means the cash flows aren't as predictable as we'd like and we require a bigger discount, but it's even more of a focus now. Wally Weitz, Weitz Funds. In valuing companies, we're putting more emphasis on the relationship between the current price and the worst-case scenario, and regardless of the potential upside, are more likely to sit and wait if that downside is material. In a sideways market, cash is not trash. David Nierenberg, D-Cubed Family Funds. It isn't human nature to view the future in terms of a wide range of possibilities. We naturally think in terms of what is most likely to occur and implicitly assess the probability of that scenario occurring at 100%. That may sound reckless, but it's what most people do, and isn't a bad way to think, as long as less likely but still plausible scenarios don't have vastly different outcomes. In the investment world, however, they often do. So making decisions solely on the most likely outcome can cause severe damage. In addition to what might be the business-as-usual case, we also want to identify 4 or 5 scenarios that are different from the recent past and analyze the present value of likely future cash generation under each. We calculate an intrinsic value and apply a probability to each scenario. Our final estimate of value is the value under each scenario weighted by its probability of occurring. A key is to capture low probability but high impact scenarios, primarily to see where the vulnerabilities are. Brian Jakubowski, Abingdon Capital. We come at valuation in a variety of ways, but the primary one is to assign probabilities to 3 or 4 different scenarios to arrive at an expected outcome, which we compare to the current share price in looking for a margin of safety. Michael Karsh, Karsh Capital. At the end of every quarter, we get a report showing the holdings we had in each portfolio 5 years ago and how those stocks have performed over the ensuing 5 years. The goal is to assess the decisions we made and whether the estimates of intrinsic value upon which those decisions were based were properly done. One thing we've learned is that we often don't give companies enough credit for the fundamental strength or weakness of their competitive positions and business models. That has resulted in selling winners too soon and in holding losers too long because we haven't had the imagination to see how bad things could get. You can never eradicate those kinds of mistakes completely, but it has made us more sensitive to both best-case and worst-case scenarios in our valuation analysis. Chris Welsh, Diamond Hill Investments. We look back as far as possible to inform what could be the worst-case levels of revenues and margins, and then apply what we think are tough multiples to the resulting worst-case earnings. If the worst case is more than 20% below the existing share price, we won't buy it, no matter how much the discount is to our intrinsic value. Charles Delardinel, International Value Advisors. We don't invest in things that could be a coin flip between doubling or going to zero. We want the downside of every holding to be no more than 10 to 15% and the upside to be at least 50%. The key for us is to not be wrong about the downside. John Jacobson, Highfields Capital. We don't invest in binary win-lose situations. A deep value manager can quite openly accept that some of his holdings may go to zero, assuming that big winners will more than offset the occasional big loser. We don't contemplate losing too terribly much on any investment. Brian Barish, Cambiar Investors. One mistake value investors can make is to focus too literally on the absolute difference between an estimate of intrinsic value and the stock price as the valuation cushion. If the range of potential outcomes is very wide, you may have much less of a cushion than you think. One big reason we focus on better quality businesses with great balance sheets is that the variability in outcomes, and therefore the risk of blowing through the valuation cushion, is lower. Dan O'Keefe, Artisan Partners. Theories of relativity. An investor's attitude toward absolute versus relative measures of valuation is often a function of how fully invested he or she expects to be. If holding a decent amount of cash is not an option, for example, a focus on relative valuation against other stocks is more likely. When cash is allowed to build, managers are more apt to wait for absolute valuation criteria to be met before acting. But even holding one's cash strategy constant, views on what constitutes actual value at any given time can vary widely. Here's how we think about it. Say the S&P 500 companies sell at 15 times next year's earnings, 3 times book value, 11 times cash flow, 1.5 times revenues, have an ROE of 17 to 18%, and have anticipated trend earnings growth of 8%. We're looking for companies with equal or superior growth characteristics that sell at discounts to the market valuation. Leon Cooperman, Omega Advisors. We're basically willing to pay average or below average valuations for companies we believe will continue to have better than average performance. Relative to more elaborate valuation disciplines you may hear about from others, ours is relatively simple. Only a small amount of our returns are from being clever on valuation when we buy. Eric Endy, First Pacific Advisors. We've developed a quantitative model that's designed to reflect the attractiveness of every company in our 1,000 company database based on 3 factors: expected earnings growth relative to the P/E multiple, the higher the better; valuation relative to the company's past history, the lower the better; and the trend in consensus Wall Street estimates. Upward movement gives us more confidence. Philip Tasho, Tamro Capital. We rely on companies' historic valuation ranges and or peer group valuations on traditional measures like price to earnings, price to book, and price to sales to identify investment targets, and then project future valuation ranges. The basic discipline is to buy in the lower quartile of the valuation range and sell towards the upper end of the long-term range. You do have to recognize if a disruptive technological or structural industry change is underway, or relative value will point you to a lot of value traps. We're always asking whether there's a transitory disruption to a business or whether there's a point of discontinuity, as was the case with Eastman Kodak. There are also analytical checks to do on past valuation levels. If there have been periods of hypernormal valuations, such as technology and telecom in the 1990s, you have to ignore those data points. Brian Barish, Cambiar Investors. One of the big mistakes value investors can make is to be too enamored with absolute cheapness. If you focus on statistical cheapness, you're often driven to businesses serving shrinking markets or that have developed structural disadvantages that make it more likely they're going to lose market share. Bill Nygren, Harris Associates. We generally avoid the most deeply discounted stocks. In a normal market, companies trading at half of intrinsic value or less often do so because there is some significant risk in the business. It may be a low probability risk, but we'll steer clear of high severity, low probability risks. In our portfolio today, we have only 1 or 2 holdings that, after the fact, have been shown to face more of a binary outcome. Timothy Harch, Brown Brothers Harriman. When I look at mistakes I've made, like buying the best subprime mortgage lender in late 2006, they've primarily been when I thought I was getting a great deal on a house, only to find out later that there had been a fire smoldering in the basement. The obvious lesson is that things that look cheap aren't necessarily so. Jed Nussdorf, Soapstone Capital. One distinction we generally try to make when betting more on industry cycles is that something should be cheap based on the current numbers, not just on what is considered normalized earnings. That makes it a more conservative investment with even more upside when the cycle eventually comes back. Andrew Jones, Northstar Partners. We focus on absolute value, trying to resist reaching for relative value justifications just because we have the cash. Relying on relative valuation is how you end up paying silly prices for houses, internet stocks, and anything else in life. Peter Keefe, Avenir Corp. I try to own businesses that are inexpensive in an absolute rather than relative sense. No position I own today trades at more than 15 times my estimate of the next 12 months' earnings. The only companies I own at more than 12% earnings are in businesses that I think are among the best in the world. The problem I've found in paying higher multiples is that you can have a differentiated view on the business fundamentals and be absolutely right, but the risk is higher that the multiple contracts and takes away your positive return. That doesn't have to happen, of course, but I want to credibly believe the multiple trajectory is biased upwards, even if that's not the primary reason I'm investing. Jed Nussdorf, Soapstone Capital. We firmly believe no investment is so wonderful that it can't be ruined by a too high entry price. So, on our discount to cash flow stocks, we will not pay more than the market multiple on forward earnings. We want to avoid the temptation of making relative valuation bets. Say, finding a software company attractive because it's only 30 times earnings when the group sells at 40 times. Christopher Grisanti, Grisanti Brown & Partners.
What you're unlikely to see us invest in is something like the Cheesecake Factory when it's at 30 times earnings.
At that level, everybody knows it's a great story, and when it comes down to it, the bet you're making is whether or not the business grows a little faster or for a little longer than people expect. Those are not the types of calls we look to make. Brian Gaines, Springhouse Capital. A fair price today is one that should allow us over time to realize on our investment the same level of compound annual growth we expect in per-share book value, earnings, or cash flow, whichever is most appropriate for the company at hand. What that tries desperately to preclude is paying so much that the business can do extremely well but the stock price goes nowhere, which can happen as businesses inevitably mature and valuation multiples shrink.
What that means practically to us is that if we find a business that meets all our criteria and we pay no more than 14 to 15 times trailing earnings, we're not going to be wildly off on price.
For any number of market, industry, or company-specific reasons, it's been my experience that we'll episodically get opportunities to pay these kinds of prices. Thomas Gaynor, Markel Corp. We look out 2 or 3 years at what a company can earn in a normal economy if our expectations for change play out. We don't look at a shorter period because so many other investors are doing that it's much more competitive. Looking out much further than that, the uncertainties go up and thus our ability to predict goes down.
We then apply a valuation multiple anchored on the average S&P 500 P/E over the last 5 decades of around 15.8 times. We consider that a fair valuation for an average company. Taking into consideration things like the balance sheet, returns on capital, growth, barriers to entry, and management quality will go up and down from 15.8 times to come up with what we believe is an appropriate multiple and apply it to our EPS estimate.
For a stock to be interesting, we want to see at least 50% upside from today's price to that fair value. Ed Wachenheim, Greenhaven Associates. I'm amazed at how common the relative valuation argument is. But you shouldn't forget that all that argument may be telling you is that bonds or another asset class might suck, not that equities are great. It's like going to Cinderella's house and meeting the 2 ugly stepsisters and being told you should be happy to date one of them. Personally, I'd rather wait for Cinderella. None of that stops people who want you to buy equities from talking about how much better they are today than bonds. What else am I going to do? Is not the most compelling reason for doing something. If there's nothing to do nothing. It's not that difficult. Absolute standards of valuation get you away from the idea that you have to be doing something, which goes all the way back to Ben Graham. He was looking at all elements of capital structure in a very unconstrained fashion, but was fully prepared to hold cash when there were no opportunities. Today, with the rise of specialist mandates and passive indexing, so many people want to be fully invested all the time. I'd argue that has caused our industry a lot of problems. James Montier, GMO. Pulling the trigger. Timing may not be everything, but it's certainly of keen importance in making the ultimate decision to buy a stock. That decision can engender any number of caught-up-in-the-moment types of emotions, exactly what reasoned, rational investors try to avoid, and the vast majority of the time will be deemed in hindsight as having been excessively early or late. In making the final buy call, the best investors strive mightily to maintain the same patient and careful process that got them to the point in the first place. Some find virtue in a team-based approach to pulling the trigger. Others argue that too many cooks spoil the broth. One of my favorite investing quotes of all time is from Joe Rosenberg, Lowe's Corp's chief investment strategist for many years, who said the secret to outperformance is to have opinions at extremes and wait for extreme moments. We're willing to wait for the perfect pitch rather than swing at things that look pretty good. It's not that hard to find pretty good values. It's much harder to be patient and only buy the great ones. Chris Middleman, Middleman Brothers, LLC. Once we act, we forfeit the option of waiting until new information comes along. As a result, not acting has value. The more uncertain the outcome, the greater may be the value of procrastination. Peter Bernstein, in Against the Gods. In a world in which most investors appear interested in figuring out how to make money every second and chase the idea du jour, there's also something validating about the value investing message that it's okay to do nothing and wait for opportunities to present themselves or to pay off. That's lonely and contrary a lot of the time, but reminding yourself that that's what it takes is quite helpful. Seth Klarman, The Baupost Group. Much of our research and analysis involves identifying companies we're willing to buy and the prices at which we'll buy them. If the market isn't offering up those companies at those prices, we sit and wait. Clients sometimes get anxious about that, but we try to remind them we get paid for results, not activity. Steve Leonard, Pacifica Capital. You obviously have to get your analysis right to be a great investor, but success also comes down to patience. We think of ourselves a bit like a lion lying in wait. There are plenty of gazelles running around, but we can't run after them all, so we wait for one to get within 125 feet before we go. Not 150 feet or 200 feet, but no more than 125. Sometimes the market offers up those great kills, and we try to do our best to be ready and to take advantage when they come along. Francois Parento, Defiance Capital. In a typical year, the average large-cap stock fluctuates about 50% from its low to its high. If you've done your homework and you're patient, more than enough opportunities to buy will come along. Donald Yachtman, Yachtman Asset Management. As Graham Dodd and Buffett have all said, you should always remember that you don't have to swing at every pitch. You can wait for opportunities that fit your criteria, and if you don't find them, patiently wait. Deciding not to panic is still a decision. Seth Klarman, The Baupost Group. I've never considered it a legitimate goal to say you're going to invest at the bottom. There is no price other than zero that can't be exceeded on the downside, so you can't really know where the bottom is, other than in retrospect. That means you have to invest at other times. If you wait until the bottom is passed, when the dust has settled and uncertainty has been resolved, demand starts to outstrip supply and you can end up competing with too many other buyers. So if you can't expect to buy at the bottom, and it's hard to buy on the way up after the bottom, that means you have to be willing to buy on the way down. It's our job as value investors, whatever the asset class, to try to catch falling knives as skillfully as possible. Howard Marks, Oak Tree Capital. You must buy on the way down. There's far more volume on the way down than on the way back up, and far less competition among buyers. It's almost always better to be too early than too late, but you must be prepared for price markdowns on what you buy. Seth Klarman, The Baupost Group. SAC Capital's Steve Cohen thought it was the silliest thing in the world to try to capture the first and last part of a stock's move. Those were the most dangerous parts of investing. For me, I'd like to capture more of the early part of the move and leave the latter part for somebody else. In general, if you're right on the fundamentals and can capture the big, fat middle portion of a stock's move, you're going to make a lot of money. Robert Chaffee, Force Capital Management. I'm a value guy at heart, so would rather buy early than late. The problem with being late is that you're already paying for the turnaround itself, so you have to count much more on the turnaround resulting in sustained revenue and profit growth. Kevin O'Boyle, Presidio Fund. A common expression we use around here is the Chinese one. To have known and not to have acted is not to have known. We try to fight against statements like, this would be a great investment if it was 10% cheaper. That's a wussy conclusion because you can't be wrong. If it goes down, you can say you knew it was too expensive. If it goes up, you can say you knew it was a great investment. But if you know it's a great investment, you should buy it. Christopher Davis, Davis Advisors. When we were buying Coca-Cola years ago, I'd lay out for other investors one part of our thesis, that enormous demand in emerging markets could eventually turn Coke into a growth stock again. But many of them just weren't interested. Tell me again in a couple of years, they said. If we're comfortable that value will compound over a long period of time, we think it's not productive to try to time so precisely when to get in. It's too hard, and you often end up missing out. Boykin Curry, Eagle Capital. Sir John Templeton, who always argued for buying during periods of maximum pessimism, had one of the best methods for keeping emotion out of the process. He used to do his calculations of intrinsic value when there wasn't a lot going on in the market. He'd then place a margin of safety on those intrinsic values and place buy orders with his broker at, say, 40% below the current market price. I'm sure a fair amount of those orders never got filled, but if there was an enormous dislocation in the market or an individual stock, the order would fill. Psychologically, that kind of pre-commitment is a very powerful tool to help us in periods of emotional turmoil. If you look at something when it's just gone down 40%, you're probably not going to want to touch it because it just warned on earnings or something similar. James Montier, Société Générale. In general, we try to constantly remind ourselves that when an industry goes south, things often get worse than you expect and stay bad longer. There's usually plenty of time to find the bottom. John Dorfman, Thunderstorm Capital. Our primary mistake in 2008 was buying too soon when the market started cracking in September. My takeaway? Sometimes it's best to let the other guy try to pick the bottom. In sell-offs like that, there will be plenty of room to get in on the upside. Carlo Canal, Canal Capital. Many value investors will buy the cheap company when there's just a turnaround story attached to it, but we patiently wait for the fundamentals to improve first. The philosophy works because investors underreact to both positive and negative changes in fundamentals. If a company has chronically underperformed, investors dislike it, don't trust management, and won't give them the benefit of the doubt. When things improve, it takes a long time for people to believe it and incorporate the improvement fully into expectations and valuations. If we see all the ingredients of a sustainable turnaround, we'll buy after 1 quarter of good earnings, allowing our clients to benefit from the slow rebuilding of confidence that will be reflected in the stock price over time. Kevin McCreish, Systematic Financial Management. You have to be reasonably early, and we of course love to get in at the absolute bottom, but so long as our valuation work indicates enough upside and we're confident in management's ability to execute, we'll initiate a position even after a restructuring is well underway or a problem is already on its way to being fixed. Jerry Sensor, Institutional Capital, LLC. The potential efficiency of combining value and momentum factors has always been a consistent theme of my research. Our trending value strategy still identifies the best values in the market, with the added twist that it then chooses from that narrow list the stocks that have increased the most in price over the past 6 months. In other words, we're looking at stocks that are still really cheap, but the market has started to take notice. I wasn't surprised that it worked. Incorporating an element of price momentum can counteract value investors' tendency to buy too early and fall into value traps, but I'll admit that I was surprised by how well it worked. James O'Shaughnessy, O'Shaughnessy Asset Management. Valuation predominates in our models, but we do believe value managers underweight positive share price momentum in their portfolios. The obvious reason is that stocks with positive momentum are often overpriced, but when they're not, we think its presence helps us avoid value traps. We'll ignore momentum if there's sufficient value-based justification, but if our awareness of the effect of momentum indicates we should buy later rather than sooner, we will. Paul Vazolis, Wedge Capital. One thing we may do a bit differently from others is that once we've identified a stock as something in which we're interested, my 2 partners and I will all separately look at the valuation and arrive independently at what we think we ought to pay, based on the potential upside and, as importantly, the potential risk. When we reach different conclusions, that leads to a very important back and forth as we try to find a meeting of the minds. We absolutely believe the end decision is better as a result. Jonathan Shapiro, Kovitz Investment Group. We have 3 people in charge of the portfolio, and we require unanimity on a stock in order to buy. That's not to say we have to feel equally strongly about something, but a great thing about having different intuition is that we're less apt to skim over something important because we're looking at things the same way. Christopher Grisanti, Grisanti, Brown and Partners. We've never thought it was a good idea to demand unanimous agreement in making buy decisions because the best investment ideas tend to be somewhat controversial. The risk in forcing unanimous agreement in any committee structure is that you too often weed out your better ideas. Bill Nygren, Harris Associates. I've sat on buy list committees where everyone had to agree, and while it sounds comfortable and prudent, it doesn't work. Every good idea with a creative or provocative angle, somebody's not going to like it. You end up with ideas that don't offend anyone, which aren't likely to be very good. Scott Satterwhite, Artisan Partners. Part 3. Active Management. Chapter 8. The Portfolio. The majority of the popular discussion about stock investing focuses on what are you buying today? There's no question, of course, that intelligent buying decisions are a prerequisite for successful investing, but there's also no question that smart buying isn't at all sufficient to ensure success. Equally important are the less sexy aspects of equity investing involved in portfolio construction and management. How are positions sized? How many positions are held? How actively are holdings traded? How are portfolio risks assessed and what efforts are made to mitigate them? Is hedging a part of the strategy? Is shareholder activism? Finally, among the most vexing topics an investor must address, how do I decide when to sell? These more nitty-gritty aspects of equity investing again highlight the variety of strategies and methods employed by otherwise like-minded investors. While the specifics will differ, what shouldn't vary is the investor's ability to articulate in detail how the portfolio is managed and why. Based on our experience, fuzziness here, relative, say, to describing one's buying discipline, is a warning sign. Concentration versus diversification. One of the most basic elements of portfolio strategy is determining the number of positions to hold. While the subject of much analytical research over the years, about which accomplished investors are typically well versed, the question of how concentrated or diversified one's portfolio is often appears driven as much by personal experience, comfort level, and feel than anything else. When Warren lectures at business schools, he says, "I could improve your ultimate financial welfare by giving you a ticket with only 20 slots in it so that you had 20 punches, representing all the investments that you got to make in a lifetime. and once you'd punched through the card, you couldn't make any more investments at all. He says, under those rules you'd think carefully about what you did, and you'd be forced to load up on what you'd really thought about, so you'd do much better. It's not given to human beings to have such talent that they can just know everything about everything all the time, but it is given to human beings who worked hard at it, who look and sift the world for a mispriced bet, that they can occasionally find one. And the wise ones bet heavily when the world offers them that opportunity. They bet big when they have the odds, and the rest of the time they don't. It's just that simple. Charlie Munger, Poor Charlie's Almanac. The strategy we've adopted precludes our following standard diversification dogma. Many pundits would therefore say the strategy must be riskier than that deployed by more conventional investors. We disagree. We believe that a policy of portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which an investor thinks about a business and the comfort level he must feel with its economic characteristics before buying into it. Warren Buffett, 1993 Berkshire Hathaway Shareholder Letter. Value investors should concentrate their holdings in their best ideas. If you can tell a good investment from a bad one, you can also distinguish a great one from a good one. Seth Klarman, The Baupost Group. In our separate accounts, we typically hold 10 to 15 securities. In our partnership, we're typically more concentrated, with the top 5 positions making up about 65% of the portfolio. If you didn't have partners, our concentration would be even higher. You know how much of Warren Buffett's partnership held in American Express when he bought it after the DeAngelis salad oil scandal? 40% or so. A company compounding capital at way above average rates, when I have great confidence that it will continue and the valuation is modest, I want to hold it at a size where I can have a material impact on the portfolio. The rationale is that simple. Chuck Akre, Akre Capital Management. We typically have 15 to 20 positions. Our general feeling is that if we don't like something enough to own a 5% position in it, we should wait to find something else. Put another way, if the only way you can feel comfortable about an idea is to own less of it, to my mind, that tells you something about the quality of the idea. Andrew Jones, North Star Partners. We're deliberately concentrated on 10 to 14 investments for 2 reasons, related to time. First, it takes considerable time to learn enough about a company, its people, and its industry to develop and maintain a proprietary level of inside information, or knowing more than the street. The second relates to our focus on activism. Pushing for change at companies takes a lot of time. I will say that I have in the past fallen into what I call time traps, where I've spent too much time trying to resolve problem investments. We will pick our battles, but usually we're better off helping our best investments maximize opportunities than trying to perform brain surgery on dogs. David Nierenberg, D-Cubed Family Funds. Owning fewer than 15 stocks, I'd have a lot more risk of being wrong with one company than I'd like. At the same time, if I owned 30 to 40 stocks, experience tells me that roughly half would be my favorites and other half would either have less upside potential or more risk. Rather than force myself to make that choice between less upside and more risk, I would rather just limit the number of individual holdings to 15 to 20. Most managers would buy the stocks with more risk rather than give away upside, which can often offset whatever benefit they think they are getting from greater diversification. Ed Wachenheim, Greenhaven Associates. We're not playing a probability game, where you invest in 100 businesses and do fine if 70 of them succeed and 30 do poorly. We're trying to select 25 to 30 businesses to own, and we count on all of them doing well over a 5-year period. Timothy Harch, Brown Brothers Harriman. We think there are profound research advantages in concentration. This is a world of very smart people, and you can't enter that marketplace without a profoundly humble view about how you're going to win. For us, concentration and depth of research allows us to go to bed at night and feel like we have a defensible source of our returns. Adam Weiss, Scout Capital. We ideally hold 25 to 35 positions, with a core holding at around 5%. That gives us most of the free lunch of diversification and allows us to maximize return by owning only our best ideas. There's also a human element to limiting our number of positions. With 25 to 35 stocks, our entire investment team knows every company and we can have a clear opinion on it. With 100 stocks, you can't do that. The portfolio manager can only know how well each individual analyst is doing by the performance of his or her picks, as opposed to evaluating the decision inputs. Suddenly, the reality of reviews and compensation force you to look at that performance over shorter time periods than you should. The analyst knows that, of course, so then starts worrying about whether Walmart's same-store sales next month are going to disappoint, rather than whether the company is creating long-term value. So we think a long-term strategy just works best with no more than 35 stocks. Boykin Curry, Eagle Capital.
We typically hold 30 to 35 stocks. We cap any one position at no more than 6% of the portfolio, but we won't put anything in the portfolio at less than a 2% position. Setting things up this way keeps us from being distracted, makes us dig that much harder for truly interesting ideas, and forces us to make active decisions. Any one holding is too important to let slide if it's not working, and there's always healthy pressure on existing holdings from new ideas. We want to take away the drag of inertia, which can be very strong in human psychology. Mark Gordon, Dunrima Capital Management. We're fairly concentrated, with about 70 to 75% of our capital in our top 20 positions, so we know what we own and don't need a lot of statistical analysis to figure out where we're exposed. We think concentration is the key to big performance, but we also have no desire to have our year depend on one or two things working out, so we have generally kept our largest positions at 5 to 8% of total capital, and make sure those big positions are not particularly speculative or highly levered. Gary Klar, Jana Partners. Our view is that too much diversification in many cases reflects the fact that the portfolio manager isn't doing the work to fully understand the businesses. If you do the work and find a great business run by great managers at a great price, that ought to express itself in the size of the holding within your portfolio. It's uncommon for us to go above 10% on cost in a given name, but we've held appreciated positions as high as 20% of the portfolio. We generally don't think you can have too much of a good thing. Peter Keefe, Avenir Corp. When we see competitors holding 75 to 100 positions with 75 to 100% annual turnover, we're either very impressed with their ability to keep track of 150 or more companies, or we're skeptical of their ability to credibly follow that many companies. We don't have anywhere near that many good ideas in a year. Eric Endy, First Pacific Advisors. Given that our funds are concentrated both in the absolute number of positions we hold and in the number of industries that are represented, it's natural for our performance to be lumpy. If the alternative is being consistent but mediocre, we would much prefer to be streaky but good. Wally Weitz, Weitz Funds. Diversification is an important part of our risk management. Average individual positions range from 1 to 2%, with the largest core positions at 4 to 5%. In 15 years, we've had 3 positions that got as high as 8%, 2 that worked out very well, and 1, Tyco, that was a disaster at the time. An important percentage of the firm's total capital is our own money, and we're just trying to do what we think is intelligent in a highly uncertain world. I don't know how some of these young hedge fund guys do it, being 160% gross long and 40% net long. I'm not questioning anybody, but if you're running a lot of capital, to be that gross long, you have to either have enormous positions where you give up liquidity, or you have to have an incredible number of positions, too many to follow effectively. Our level of diversification reflects our unwillingness to make such giant bets or to give up liquidity. We could liquidate our portfolio in 48 hours. Leon Cooperman, Omega Advisors. With 6 analysts and the amount of money we have, 50 to 60 positions has turned out to be what we feel we can best manage. It's not more concentrated out of prudence and humility. There's always a chance we'll be wrong on any given idea. Spencer Davidson, General American Investors. Part of our rationale for holding more than 300 positions at a time is just the practical reality of running $8 billion in a small-cap strategy. With that much money, you can't hold 50 stocks without moving well out of small-cap range for many of them. Another practical consideration is our investor base, which is retail investors and large institutions. Performance obviously matters when they choose T. Rowe Price to run their small-cap assets, but they also want to be comfortable that the portfolio isn't going to blow up. For many investors, volatility is the enemy of rational investment decisions, so the less volatile we are, the more likely our investors won't sell at the bottom and buy at the top. Running with the level of diversification we have, the standard deviation of our returns has been lower than that of our benchmark Russell Index. Philosophically, I find broad diversification makes it easier to be a contrarian. We made the mistake in 2007 of buying some housing, recreational vehicle, and mobile home stocks after they fell 50%, which clearly turned out to be too early. But because of the way we run the portfolio and our recognition of the risks involved, we never made those holdings in aggregate more than 3% of the portfolio. While that particular out-of-favor bet hasn't paid off, it hasn't hurt us much either. As long as the potential upside is high, we should be making those types of investments, and they can make a real difference when they work. Preston Athey, T. Rowe Price. Small-cap stocks by definition are more fragile, more likely to have one dominant product or one key executive or one big customer. Strange things happen, so you have to diversify no matter how much you may love individual names. When something strange happens in one of Johnson & Johnson's or GE's businesses, it's a rounding error to the overall company. In a small cap, it can blow it up. so you don't want to be overly exposed in any one name. Whitney George, Royce & Associates. Concentration and microcaps don't mix well, so we typically own around 100 names, with a big position being 3 to 4% of the portfolio. Tiny companies are by definition more vulnerable to catastrophe if something goes wrong, so we try to limit the potential damage from that by owning a lot of them. I've had people ask if we're spreading ourselves too thin by owning so many positions at a time. What I answer is that there's an enormous difference in the effort required to follow a big company than a small company. I'd argue that a portfolio of 20 large-cap companies, each of which is in 5 or 6 distinct businesses, is more difficult to keep track of than 100 small companies that typically operate in a single niche. An IBM or a Disney can have a single footnote longer than a lot of the entire annual reports I look at. Paul Sonkin, Hummingbird Value Fund. Our level of diversification, 130 to 140 positions, is just spreading the risk. It serves us well during downturns, which was certainly reinforced in 2008. I think it also makes us less emotionally attached to the ideas and more willing to admit we're wrong, which is important for any investor. Tom Perkins, Perkins Investment Management. Our flagship mutual fund today has 30 stocks. Buying things when they meet the valuation characteristics that have worked for us in the past is our selection methodology. Period. It's not about picking the best 5%, 10%, or 20% of those. I don't want to know which ones those are. We've done distribution analysis of our winners and losers. 18% of our stocks have lost 50% or more, while 25% have made 250% or more. The math has worked in our favor by exposing ourselves to as many multi-baggers as possible that meet our valuation criteria at the outset, and then patiently waiting. John Buckingham, L. Frank Asset Management. While we've generally avoided being hurt by underhanded executives, that risk is always there, and it's far more pronounced if you're running a concentrated global portfolio. A second reason we're more diversified, with up to 150 stocks, is because I believe a lot of our alpha comes from being in the right sets of companies rather than the right specific companies. If we get the themes right, we'll do as well, with lower volatility, owning more names rather than fewer. Oliver Kratz, Deutsche Asset Management. The knock-on funds as diversified as ours is that they're index huggers, which, given the geographic breadth of where we invest, is not at all the case for us. I know the argument that you should own only your best 30 or 40 ideas, but I've never proven over time that I actually know in advance what those are. Jean-Marie Eviard, First Eagle Funds. The size that fits. A corollary to the determination of how many positions generally to hold is how to size those positions relative to each other. Tolerance levels for larger position sizes obviously vary, but even the most concentrated investors at some point typically respect the admonition not to put too many eggs in one basket. We believe in constructing the portfolio so that we put our biggest amount of money in our highest conviction idea, and then we view the other ideas relative to that. We find things that we think are exceptional only occasionally, so if we find something that is really set up, where we think it is mispriced, where we have a good understanding of why it's mispriced, where we think the mispricing is very large and the overall risk is very small, we take an outsized position to make sure that we give ourselves the chance to be well compensated for getting it right. David Einhorn, Greenlight Capital. We're in the camp that there just aren't that many good ideas, and when we identify one, we want to make sure it can have a meaningful impact on performance. The biggest holdings are those in which we have the most conviction, which is a function of several things: the size of the discount, the potential for intrinsic value growth, having a clear and strongly held variant view, identifying a meaningful catalyst or catalysts, liquidity, and the extent of the positive impact on portfolio diversification. Steve Morrow, New South Capital. Perfect investments have 3 layers of return. The first layer is the short-term return to what I'd call static intrinsic value. The second is when the business, strategy, and management turn out to be what you think they are and there's real value creation. The third layer, if you're really lucky, is when the market gets so excited that it discounts more and more of the future into the present. The big home runs are usually there. I always try to find at least 2 layers of potential, but it's also important to recognize when you put something in your portfolio, whether it's a 1-layer or 2-layer name. You should make a 2-layer name a bigger position. Lisa Rapuano, Matador Capital Management. We're looking for a total annual return of at least 25%, with position sizes adjusted for the degree of difficulty. For a given expected internal rate of return, the lower the outcome's expected volatility, the higher the position size. We create an estimated risk-adjusted internal rate of return for everything, and then allocate the portfolio based on that. Stephen Tannenbaum, Golden Tree Asset Management. In holding stocks 40 at a time, we're trying to get the appropriate balance between diversification and putting most of our dollars in the names we like best. As a practical matter, it's difficult to find 40 names that you really like. The lion's share of your excess returns will come from a few names. The trick is identifying which those will be and placing bigger bets on them. Our clients typically require we limit maximum position sizes to 4%, but even with that restriction, it makes a big difference in results over time if your largest positions outperform. Paul Vazolis, Wedge Capital. Our position sizes are set based on how well each company fits our 3 investment criteria: valuation, business quality, and balance sheet strength. If it clears each hurdle with flying colors, it will be at the top end of the portfolio in terms of position size. If, say, it's cheap and the business economics are fine, but it just clears the hurdle on financial soundness, it will be at the bottom end. That gives a risk-to-reward profile to the entire portfolio. It's perfectly fine that our deepest discount stocks may not be our biggest positions. George Sertle, Artisan Partners. Our positions tend to be equally weighted. We know there are potential errors in the portfolio, which we'd obviously avoid if we could predict what they were. Since we can't, we assume the future errors are randomly distributed, which is a primary reason we equally weight the positions. Bernard Horn, Polaris Capital. My view is that whatever edge I have comes more from knowing where to shop than knowing specifically which of the items I buy will be the best, so I maintain roughly equal stakes to reflect that. Ralph Shive, Wasatch Advisors. For each position, we define a downside price at which the stock would trade if everything about our thesis turned out to be wrong. In deciding whether to put something into the portfolio, we'll assign probabilities and look at the expected value, but the downside is particularly important in sizing the position. We don't want to lose more than 100 basis points in return in any one position, so if our downside is 20% below the current price, say, we'd put on no more than a 5% position. Curtis McGwen, Ivory Capital. Our calculated downside price is extremely important in how we size positions. We limit each position to a maximum risk, measured in basis points, to our downside price. In other words, if a stock went to its downside price, we don't expect the fund to lose any more than the maximum risk we've defined for that particular position. Jeffrey Smith, Starboard Value. Being concentrated doesn't mean we'll just take the 15 best ideas we have and plug them into our portfolio. Because of that level of concentration, the companies we choose will overall likely be less cyclical, with more stable underlying business models. We at the margin will be less apt to hold names with higher expected values if that coincides with much larger downside risk. Lee Etzel, Pennant Capital. In periods of rapid change in liquidity and economic conditions, the odds that we're simply wrong about our estimates of companies' near-term fundamentals are higher than average. As a result, we're more focused then on maintaining flexibility through cash levels and buying power, and in sizing our bets according to the medium to lower confidence environment we're in. We won't necessarily make fewer bets, but they'll be smaller in size. Larry Robbins, Glenview Capital. What tends to happen is that as the market gets more expensive, we take on more, less discounted names, and when the market is less expensive, we'll have fewer names trading at bigger discounts. At the market peak in 2007, for example, we held about 40 names in our large cap portfolio, and the overall price-to-value ratio based on our estimates got to 82%. The other extreme was March 2009, when our weighted average-to-price ratio got down to 40%, and we concentrated the portfolio in 18 names. C. T. Fitzpatrick, Vulcan Value Partners. Our fund usually has 40 to 60 positions. The actual number at any time is usually a function of how pricey the market is. When discounts are larger, the full weights tend to be 2 to 4%. When discounts aren't as large, position sizes are more like 1 to 3%. Eric Cinnamond, Intrepid Capital. I will not put more than 5% of the portfolio in any stock, and we usually don't have more than 2.5%. Early in my career, I had 20% of my portfolio in Johnson & Johnson, just before Tylenol was laced with poison. My objective is to produce an above-average long-term return, and I think I can do that without taking that kind of concentration risk. Things happen. If I really knew the best stock in my portfolio, I'd put 100% of the portfolio in it, but I don't. Financial columnist Dan Dorfman once asked me in an interview what the best and worst stocks were in my portfolio. I told him the worst stock was Converse, the shoe company, which he dutifully reported in his column. It got taken over 2 days later, up 50%. Robert Olstein, Olstein Capital Management. Our not letting a single position get more than 5% of the portfolio is a function of having seen the stocks of too many good companies fall off a cliff as a result of something out of left field. One example I like to use is when Merck announced it was pulling Vioxx off the market in 2004.
You went to bed with the stock at $45 and woke up with it 25% lower. I'll give up some of the upside you might get from an outsized position in order to be better protected from a risk you couldn't possibly foresee. Robert Kleinschmidt, Tocqueville Asset Management. Cognizance of correlation. A portfolio's level of concentration or diversification can clearly go beyond just the number of stocks held, also encompassing how apt holdings are to move in concert as a result of market moves or broader macroeconomic and industry trends. To some investors, this is critical input into the portfolio's risk-to-return profile, while to others, it's only a passing reference. We have what we call a risk bucket model. We look at the sensitivity of each of our holdings to several macroeconomic factors. Is it economically sensitive or recession-resistant? Is it hurt or helped by increases in energy prices or interest rates or the dollar? Does it have political or regulatory risk? By assigning positions to any appropriate buckets, we can better understand the extent of the risks we're taking on a portfolio level. There aren't any triggers or limits, but we need to know our exposure to things like widening credit spreads or a higher dollar's impact on exports, and then be comfortable with that exposure. This comes most into practice when we're considering a new buy and want to know its potential impact on portfolio risk and diversification. Steve Morrow, New South Capital. We tag every stock in our portfolio for more than 40 possible spread risk factors on which stock prices can diverge dramatically. The factors include common ones like sector exposure, market cap, liquidity, leverage, and dividend rates, and maybe less obvious ones like exposure to China or the constitution of the shareholder base. At any given time, for example, we'll know that 16% of our longs and 13% of our shorts are in highly leveraged companies. We'll know our exposure to companies that should perform well in an inflationary environment versus those that won't. We focus on managing the spread risks between our longs and shorts so that we don't have significant exposure to unintended bets. We want our returns to derive from our skill as analysts and not from all the other factors that can create price volatility. In other words, the goal is for our longs and shorts to move relatively in sync with each other while we wait for the fundamental catalysts to revalue our longs upward and our shorts downward. Curtis McGwen, Ivory Capital. We're keenly focused on how our holdings line up as cyclical or non-cyclical. We have a lot of macro concerns, but it's difficult to translate those into an investment strategy when our investment horizon for individual stocks doesn't match up particularly well with how the macro issues may play out. Our base case position is that the U.S. economy will sustain tepid growth through the dramatic deleveraging process the country is going through. But that may play out in a relatively organized fashion over 20 years, witness Japan, or it may cause a severe crisis in 1 or 2 years, witness what's going on in Europe. Our approach in the face of all that has been to keep the portfolio somewhat balanced between cyclical and non-cyclical exposures, while being tactical and moving toward or away from either. Timothy Beyer, Sterling Capital Management. I never pay attention to sector or industry concentrations. I don't believe it's a reliable tool for diversification. Enron and the banks that lent to Enron were in entirely different sectors, but their fortunes were tied by that relationship. If I own Nestle, am I geographically diversified by holding a company that has its headquarters in Switzerland, but earns almost none of its revenue there? I do pay attention to codependencies of outcomes between companies, and think true risk reduction comes from purchasing securities that are inversely or non-correlated. For example, owning natural gas producers, which benefit from a rise in natural gas prices, and also holding natural gas-based utilities that benefit from a price fall would reflect hedging for inversely correlating outcomes. As an example of non-correlation is the relationship that mostly exists between the economic climate and the volume of securities traded on exchanges. While the economic climate may impact many securities we hold, the success of the publicly traded exchanges we own is largely independent of it. Murray Stahl, Horizon Asset Management. We pay attention to end-market diversification, within our companies and across the portfolio. One large holding in a company with 5 separate global financial businesses is probably more diversified than 5 holdings in similar regional bank stocks. Our goal is to own businesses with uncorrelated enough end markets that we can continue growing the intrinsic value of the portfolio in any kind of market. Brian Bears, Bears Capital. Long to short funds typically don't blow up because they made a bunch of wrong fundamental stock picks. They blow up because they're overexposed to correlated sectors, or they own too many leveraged companies, or they have too many illiquid positions. These are explanations you see all the time in funds' letters to investors. That's exactly what we try to avoid. Curtis McGwen, Ivory Capital. Our rule is to own something in every sector, in part to avoid missing something important because it's out of sight, out of mind. We're not a slave to our benchmark, the Russell 2000 Value Index.
but I typically don't go much below half or much above twice the index weighting in any sector. I've found that gives us plenty of room to beat the index while avoiding the type of relative volatility that makes most investors nervous. Preston Athey, T. Rowe Price. We have sector limits at plus or minus 10 percentage points from the percentage weighting of the 10 S&P 500 industry sectors. That gives us the flexibility to zero out sectors that are less than 10% of the index, like utilities and telecom today, or overweight fairly heavily in sectors we find attractive, such as energy. But it does put limits on how under or overweighted we can be, which we think provides prudent diversification and risk management. Daniel Bubis, Tetram Capital. One of our biggest mistakes was 10 years ago, going too heavily into emerging market closed-end funds, which were selling at 25 to 30% discounts. When the Russian debt crisis hit, the NAVs got hammered. It's one of the first lessons you learn. Be diversified enough that if that 1 in 100 event happens, you don't blow up. Philip Goldstein, Bulldog Investors. In our flagship domestic and international products, we do not hold individual positions over 5% and will not have more than 30% in any one sector. Historically, whether it was energy in the 1980s, technology in the late 1990s, or financials more recently, when a single sector approaches 30% of our portfolio or of the market, that signals the end rather than the beginning of great investment performance. Jeffrey Sensor, Institutional Capital, LLC. We cap a given industry's exposure at 25% of the portfolio, which is a check on the innate lack of humility we often have as investment managers. Owning 5 or 6 4% positions in an industry is a good, strong bet, but also isn't betting the house on how smart we are relative to everyone else. Jeffrey Bronchick, Reed, Connor, and Birdwell. People tend to assume that the only form of active portfolio management is through relatively concentrated portfolios. We think there's an equally legitimate form of active money management in running a diversified portfolio that has nothing to do with the benchmark. Charles Vandelow, International Value Advisors. We don't benchmark at all. I don't care if we own almost no financials, and I don't care if we own an excess amount of energy. We'll go where we think the value is and let the weightings fall where they may. Stephen Romick, First Pacific Advisors. We've purposely avoided basing our bonuses on performance against benchmarks. We're always running into managers who say they're unable to look at certain stocks because they don't fall within a prescribed benchmark. They tell us, I can't take the risk. If I buy it and it goes down, I'll have to write all sorts of memos explaining it, and I'll get less bonus because my portfolio went down more than the benchmark. Bernard Horn, Polaris Capital. You can understand why many succumb to the pressure to hug the index, so to speak. But we believe if you go down the road of trying to make sure you'll never do much worse than the index, you're almost ensuring that you'll never do well enough to justify your compensation as an active manager. Bill Nygren, Harris Associates. The only way to add value as an active manager is to be persistently different than the index. We tell prospective clients that if their main goal is to minimize standard deviation around the index, save money and buy an index fund. Jeffrey Bronchick, Reed, Connor, and Birdwell. Chapter 9. Playing the Hand. Fundamental value investors will aggregate toward the lower end of the activity range when it comes to day-to-day trading in their portfolios. The primary reasons the stocks they favor are undervalued. Market neglect, company-specific operating troubles, an out-of-favor industry tend to be situations that work themselves out over longer periods of time, making patience a virtue. That said, the embrace of a traditional buy-and-hold mentality, particularly in a market in recent years that has been characterized by high share price volatility, is by no means universal. As much as we would all love for subsequent events to conform beautifully with our original expectations, that rarely happens, and the best investors can well articulate how they prepare and execute their responses. Some, through activism, look to take the resolution of outstanding or evolving issues that impact shareholder value more into their own hands. Trading mentality. We don't know what kind of an investor poker legend Amarillo Slim, born Thomas Austin Preston, was, but we have often found investing insight in his musings. One of our favorite quotes? The result of one particular game doesn't mean a damn thing, and that's why one of my mantras has always been decisions, not results. Do the right thing enough times, and the results will take care of themselves in the long run. As important as the decision to buy a stock is, events dictate that a variety of new decisions be made about that stock during your ownership of it. While many investors frequently conclude as those events unfold that doing nothing is the right decision, others see actively trading around positions as central to their success. Our turnover is usually in the low teens. Last year it was 8% versus an average for small-cap value funds, followed by Morningstar of around 70%.
This is driven by the belief that if you've truly done your upfront research well, you should have the patience and courage to let ideas work. I don't believe you can explain 70% turnover or more without assuming people are buying many things they don't really know and dumping them when they get a negative surprise. We're not immune to missing things, but it's rare that unexpected risks come up so quickly that we reverse course before the thesis has had a chance to play out. This obviously only works if you pay the right price going in, to the point where the downside is truly low. Preston Athey, T. Rowe Price. Our turnover is typically in the single digits. It's been when something goes up 50% in a year, but if you sell it, you've got transaction costs and taxes and then need to find an incrementally better use for the money.